All right, I hope this time it works out. Roy should be able to join in soon. I have hopefully be able to bring in all our regular guests. I'm going to share it to Alok and others. All right, he's here. Let's see. All right, Roy, I have sent you another invite. Let's see if this works this time. Roy, can you? I'm not sure if you're able to speak or try speaking. Let me know. He's on the call. Okay, I'm going to give him a call and see if what's going on. Sorry, guys. Give me a minute again.
Hello? Hello? Hello?
Yeah, we can hear you.
Oh,
Finally.
finally,
There
finally.
you go. All right.
Sorry, guys. Really sorry about
No,
this.
no, no. Worth the wait, man. Worth the wait. I know Prashant has been traveling. I'm just gonna still try him, invite him to speak, and I'm just gonna. I was waiting for you to be able to make it, and I'm gonna try and add Alok Bhai as well. Um, Meanwhile, I'll let's get the space started. I know people have been waiting. Roy, how does it feel like to be a rock star? Waiting people, tech glitches.
Yeah. Ankit had pre-planned this.
For all you know, man, you were not supposed to say that. I was trying to maintain that decorum, the tech glitch, right? I was trying to make gravity for you. But
Sorry, man.
nonetheless, it's a pleasure to have you. I see Prashant Bhai has also accepted the invite. I hope Alok Bhai also joins in. I'm gonna send him an invite again. But let me open the space. Let me kind of give an introduction to get things started. Oh, Alok Bhai is as well. Okay. So, guys, thank you everybody for joining in our spaces. Sorry about the tech glitches. We promise it was not intentional. It may be the Chinese bots or whatever bots I've been facing ever since I announced the space, and a lot of interest was seen in this. I got at least 2,000 DMs from Chinese bots from whatever kind of messages. I don't know what was going on. Anyways, now that we are on the topic, now that we are on the space, so let's get started. So we had shared a quick small summary of it. The target, the topic for today is options trading and analytical approach. So we have some thoughts on mind what we would want to discuss, and of course, everybody's allowed to pitch in. Everybody, we encourage you guys to have any questions to start asking questions. The idea is this is not supposed to be a lecture or a training kind of a session. This is more geared towards an open-ended discussion, bouncing off ideas. So we'd highly appreciate any kind of interaction from you guys. With that said, I'd like to introduce our main guest speaker for the today, Roy. As you probably have heard of him before, have seen him, his tweets. I'll let him speak about his background, but he comes from a background of options trading for his real life job. He works in a financial institution. But Roy, would you want to take up a couple of minutes to just introduce yourself quickly? I'm sure people know you, but not maybe as much as I know you, so to say.
Sure, man. Let me advertise myself. So, yeah, I mean, I have over 15 years of experience in financial markets. So, I've worked in areas of derivatives trading and sales, structuring, and quantitative trading and analytics. My current role, as Ankit said, is as a quant. I don't know how I'll define it, but like I work in a global institution in quants. So I mean, as you know me, I mean, the guys who know me know me for my disclaimers. So let me put some disclaimers before I start. All the views expressed here. Can you hear me?
Yes, yes, we can.
Oh, okay. Sorry, I thought I lost you. Yeah, all the views expressed here are completely personal, doesn't reflect any way on my employer, and this is just for educational purposes. And I don't intend to discuss any specific strategy or anything. And I mean, this may not suit a lot of people, but I want to discuss more on the frameworks we kind of look at, and I'll say as my handle says, I'm not a pro, and I don't intend to kind of sermonize that this is the only way to do things or that is the only way. Sure, you might be a technical trader, you might be a fundamental trader, or you might be a quant trader having a completely different perspective, right? So my views are I mean completely personal, and I'm going to stick with that. And I do respect, I mean, any opposing view. I mean, feel free to oppose me, and as long as we are kind of having a good discussion, I'm okay with that. Okay,
Perfect.
that's
Thanks.
that's out.
Thanks, Roy. Thanks for that lovely introduction. So, I have one question for you before you get started, right? I am interested in understanding why Sticky Delta. Why that name? What does that signify? I know it has to do something with options. So, maybe that's a good start.
Yeah, sure, man. I mean, that's a start that might not end. So, you asked the wrong question, but that's okay. I mean, sticky delta is a kind of a volatility regime where the shape of the skew curve does not change with deltas, right? So, a 30 delta versus a 50 delta skew will remain same. That's why the delta is sticky. The skew is sticky on the deltas. So, that's a regime. It's a little
Okay.
jargon you kind of put it yourself to kind of feel, yeah, stuff, right? But that's the idea. I mean, behind it.
Right.
Okay.
No, no, perfect. No, perfect. I know. I'm just, I wanted to quickly. Prashant and Alok are also on the spaces, so also they run QC Alpha, very very well versed with options trading. So I invite them to pitch in as well. So with that said, Roy, maybe we'll start going through our some of the items that we listed out on our flyer, so to say. So I think one of the topics that you and I discussed about, taking up this during this call is difference between futures and options trading. A lot of times, questions come in: Can we do this through options? Like people are trying to trade directionally, non-directionally, and there's often this misunderstanding or confusion around what constitutes trading in futures and what constitutes trading in options. Not per se that what are futures and options. I'm sure the audience is advanced enough to understand that. But we'd like to hear your thoughts on that topic. Differences on styles and where one applies what.
Sure, let's get started. So, I mean, uh, a price trader or a price analyst, and that's all my limited understanding is concentrated on the price of the product or the instrument he's trading, right? He or she is trading. So, like somebody who's trading a future is solely concentrated where the price is, what at what level it is, what price it broke down, and so on, right? So that's how a futures trader kind of who is maybe a technical analyst kind of aligns himself to the market, right? So uh, the problem of doing it with options is uh, option. If you look at just an option price and trade, right? I mean, I'm not criticizing it, or maybe a lot of people do it, and maybe a lot of people do it successfully. But my problem, or my the reason I can't do it, is because an option price is a combination of a lot of risk factors. By that, what do I mean by that? Okay, let me just break it down. If you have a futures trade, if you do a futures trade, let's say you shorted Nifty at some level, maybe let's say at 16,000, and you're sitting on profits, right? Now, tomorrow, if the market broke down another 100 points, right? So you know how much you're going to make on that trade, right? So it's kind of very kind of transparent that if the market goes from point A to point B, I'm going to make this. If it goes from point B to point C, I'm going to make this. This is where I lose. So I put my stops here. I put a trailing stop. Whatever you want to do, you can do very in a very transparent manner, right? In a very transparent manner. Unfortunately, for options, that doesn't work. The reason for that is, if you have, let's say, you bought a call option, right? And it has, let's say, 15 days to expiry. Okay. Now, if the underlying price goes up by 100 points in the next 1 hour, then the PNL on that option will be very different from if it goes up 100 points after 3 days, right? So what I'm trying to say here is we are kind of path dependent over here. That okay, that's again a jargon, but like let's kind of break it down. So a path dependence means whatever path the underlying is taking to reach to your whatever target point or something, determines how your PNL is going to be, right? So I mean, only at expiry you kind of know that okay, if the market is at this level, you know what is the PNL, you know how much you made on the option, right? So uh Ankit, give me some rope here. I mean, if this is
Yeah.
clear and understandable,
No, no,
right?
this is
So
definitely understandable.
yeah,
And maybe to help or think about this, you talked about path dependence.
yeah,
It might be useful for the audience to, if you can explain what might that mean
yeah.
before going further.
Sure, sure. So path dependence means that an underlying can go from point A to point B over a certain period, taking a certain path. Now each path will have its own MTM, right? So that is what is meant by path dependence, right? So however, in case of a future, if you know, unless you're using stops, let me qualify that by saying unless you're using stops, if a future goes from, let's say, Nifty goes from 15,750 to 15,500, then and it goes before the expiry of the future, you know that okay, you are going to make some 250 points, right? So on the future, that's kind of clear. But however, for an option it is not clear, right? So whatever strike you take, only at expiry it is clear that what is going to be the your PNL. So that's why it becomes very difficult to kind of trade an option like a future only with price. Now, an option price gives you some information, but it gives you some information, some packed up information. It gives information about sensitivity, or how much the price will move with the underlying, that is known as delta. It gives you some understanding of how the price is going to move with the change in volatility. Yeah, I'm hoping that the audience here knows basics of options, so I'm not going to go into what is volatility, but you know uh, and this kind of makes it very difficult to to ascertain what is happening. And and that kind of reflects on a back test as well. So if you do a back test on a future, then that backtest for the future is very very transparent, right? So spot, you initiated a trade at this point, the spot moved from this point to this point, and then you made money, right? So you kind of clear. Now you would argue saying that that's same for option, right? I mean, I know the historical prices for an option, and if the option price moves from A to B, I kind of know, right, what is my PNL. The way I argue this is this, that what is your fundamental assumption when you do a backtest? Your fundamental assumption is you think that however the way the past played out, the way your setups played out over a large number of trades, it's going to play out the same way in the future. Okay, nothing wrong in that. It's a good assumption. That's how a lot of trades are working, and people do make money by that assumption. But when you do it for options, you're assuming not only the spot or not only the underlying is taking a certain path, or it's going from A to B, but at that same point where that underlying is, the volatility is also same which had been in the past, right? So for a future trade you were assuming that okay, the market will move in this way, fine, one variable, right? But here now you have two variables. You have spot and you have volatility, right? You have to assume that if Nifty tomorrow drops by 200 points, in your back test it shows that the vol goes up by 1 point or 1 percentage point, right? You have to assume that it's true in your future trades as well. Now that's a big assumption, because when you are talking two variables moving in tandem in your backtest and in the same way it's going to move in your future, that's not really, I mean, a very good assumption according to me, right? And that's why, you know though option backtests can give you some insights, but it's not enough, right? So you kind of have to do something more than a backtest, which tells you that whether you're going to take the trade or not. So what are the things you can do, right? And that is my intent. I mean, that's Ankit, that's the structure I'm going to take in this spaces, that I'm going to talk about various methods you can use, whether it's good or bad or ugly or extremely good. It's up to you. It's for you to judge, right? My intent over here is just to throw those methods and discuss those openly, right? So
Yeah,
yeah.
perfect. Go for it. Bhai, go for it completely.
Yeah. So so the other thing you can do is simulation. And so what do you mean by simulation? Okay, it's a big word. Simulation means that you are creating a condition which you think the market can have, you know, and you're trying to estimate your PNL or your the MTM of your trade based on that. So what do I mean by that? Right. So you would have seen that the general levels of volatility would have gone up after COVID, right? I mean, for whatever reasons, the general levels of realized volatility. I know it's a big statement, but in general, let us assume that this has happened, right? After COVID, the general levels of volatility have gone up, right? Now, if you had, let's say, a strategy uh, which you backtested on, let's say, from 2017, because you have the data from 2017 for Nifty weekly options, and you saw that there is some level beyond which Nifty doesn't move over a certain period. Okay, it doesn't go beyond, let's say, 1500 points. I'm just making up numbers, right? So these are not real numbers, and you are kind of comfortable, okay, selling a strangle on that. So you have 1500 points, or let's say you do a 750 points up and down strangle, right? So and you're kind of okay with it, that okay, in this period it's not going to go up by that one. Now, in a back test, this is never going to show up that you lost money, right? And you'll see that time after time, you're kind of making money, your account is growing, no losses. And let's say you stopped your back test for some reason before 2020, you are going to see that it's perfect, right? I mean, this is the way to make money. But this is but as you know, in 2020, kind of the market crashed on very very serious levels, and the those options which you sold deep out of the money went in the money. So this kind of a very simplistic example, why a backtest kind of needs to change with regime. So what would a simulation do, right? A simulation would take the path of all the possible moves of the spot. So the underlying I'm referring by spot over here. From now on, I'll refer to it as spot. So the spot and the volatility, uh, you know, you're not assuming anything. You're just making it flow freely, right? It can go anywhere. Now, what do I mean by anywhere, right? So anywhere is not a very good definition, because I want to assume that it's going to fall 100%. No, right? I mean, that's not kind of what you would do. But you will have some kind of assumptions. That's what a quant does. And you are going to assume that some kind of a path, there are some path constraints which are there, some constraints which are there, which the spot is going to take and the wall is going to take. And there you're going to assume that with the change in spot, the wall also changes, right? So you are going to assume some kind of a correlation between the two. Now, having done that, this is a fair assumption. I mean, which can be used over periods of time. I mean, can be used, right? But what you're going to do is you're going to, maybe you bump up the levels of volatility, which means that, in 2017, whatever was the volatility, you bump it up by some level, and now you have a set of volatility numbers, set of stock prices, and then you backtest this thing, which, so now it's not really a backtest, because the option prices would look very different from what it was in the past. And then so it is what is known as a simulation. So we kind of look at a simulation. Now, how do we do it exactly? We assume all the paths possible for the spot and the wall, and then we assign some probabilities to those paths, right? That, okay, what are the chances of Nifty falling 20% in, let's say, 10 days, right? So you're going to assume some kind of probabilistic, you're going to make some probabilistic assumptions, and then you're going to look at how your PNL is looking, right? So obviously, if you look at a classic way of doing it, then if you use simulation without any kind of constraints or assumptions, you're going to see that you're never going to make money, right? So because there is no free lunch in the market. However, it's your understanding of the market, which you bring from other fields of studies, let's say technical analysis and, let's say, fundamental analysis, that that will help you, what we call as uh, uh, calibrating the parameters, right? So you kind of give values to those parameters, that, okay, this probability might be 20%, this probability might be 5%, there's a 5% chance. That is completely based on your judgment. And then you find what are the probabilistic PNLs you're going to have, calculate the expected PNL based on all the probabilities which you have kind of marked, and then you have a much better model compared to a backtest, because this model is kind of imitating the current scenario much better than what it did in the past. Okay, I'll stop here. I think I've spoken a lot. If anyone has any kind of thoughts on this, or Ankit, I mean, I'll probably mute myself over here.
No, no, don't mute yourself. You can keep yourself open. We don't know with the technology, but yeah. Before I let anybody else ask the question, I'm going to take the privilege of being the host and asking the first few questions myself. So one of the thoughts I've always had regarding the path dependency while trading options is the holding duration of a trade. So if you are, like you said earlier, if your DT is 15 days or if your days to expiry is 15, the path dependency is really important. But if your days to expiry, or even if your holding period is small, let's say you opened a trade on DT 15 and you closed it on DT 13. So when I say DTE, I mean days to expiry. So the in my experience and relevance, even though it is dependent to path, the sensitivity of an option price to the path dependency goes down if your holding period is down. I would like to hear your thoughts on that, Roy.
Yes and no. Sometimes it goes down, sometimes it goes up. So let's say you talk about delta. I mean, if you're in the money option, then the option, the delta of the option approaches one, right? So I mean, it keeps on going up. So I mean, if you look at, like, let's say 1 hour close to expiry, the delta will be very close to one, because it has a high chance of expiring in the money, right? So that's for an in the money option. For an out of the money option, you're absolutely right, the delta bleeds and it moves towards zero. So if you are very close to like option expiring, the out of the money, then the delta will bleed towards zero. So yes, I mean, these are complications which are there, and the complications increase as we come close to expiry. However, what I meant was, at expiry, I mean, if you know the underlying level, or if you know the level, what was the payoff of your option, which is after the option has expired. That's what I meant.
Right.
Is that
Uh,
Does that answer your question?
yeah, it does. I mean, I understand closer to expiry, the sensitivities are higher. But I was also alluding to the fact that if you just hold it for 1 day, your sensitivity, even though dependent on your price sensitivity on the path, may or may not be that sensitive. But I could be wrong. So I'll move on to the next thought that I had. So this spot wall correlation that you talked about, right? Uh, how do you think can we call it in a regime analysis? I mean, I know regime analysis is a very broad term used in various of ways, but in an options backtest or in the simulations that you talked about, having this spot wall correlation with a specific look back, because you need a look back period or a window on which you'll calculate your correlation on, can this be used as a way to a simple or a dirty measure to quantify a regime, that or regime, or it could be 1 day period, 2 day period, one intraday period, or whatever? What are your thoughts on that?
Yeah, it's a tough question. I mean, and maybe some experts here can answer that. But my thought is, first let's start with a correlation or a beta, right? I mean, so beta is nothing but covariance between the spot and the vol divided by the volatility or the variance of the market, right, or the spot, right? So that is known as beta. So beta means that if spot moves by X, the wall will move by this many percentages, right? So it's kind of a linear correlation, right? So it's kind of a linear relationship between the two. Okay, that's kind of a simplistic assumption, and I'll tell you, like, why we do this, right? So let's say, the you are holding a call option, and like it's at the money right now, and you are trying to estimate what is going to be my PNL if the market moves 100 points, 100 points up, and after 3 days, right? So that's kind of one of the scenarios you have, that okay, there's an event, and if something happens in this event, the market is going to move, let's say 500 points. 500 points, I changed 100 to 100, 500, and uh, it's going to happen in 3 days, because after that event only the market's going to move. Let's say you have this kind of a scenario, right, and you're holding a call option. So the complication here is, not only that, okay, the 500 points is known, right? So from here to 500 points there'll be a move. Whether the how much the call is going to move. At what level the market is. So how much in the money, the moneyness of the option, right? So a 50 delta option kind of goes in the money. So it becomes, let's say, a 70 or a 75 delta option or whatever. Now the thing is, what you don't know is what is going to be the volatility at that time, right? So what do you do for that kind of thing? So for that, you can't estimate it from the market, because the market right now is, let's say, showing you a a 5 day wall, a 5 day option price, a 15-day option price, a 30-day option price, and so on. So it shows in gaps, right? So now after 3 days, that your 15-day option is going to be a 12-day option, right? So how would you know a 12-day option price today, sitting today? All right. Because you don't know the volatility input. So for that, we need a continuous curve, which is kind of going to tell you, okay, at this strike, the volatility is going to be like this. At this strike, the volatility is going to be like this, and so on. Right? Are you able to get me? Is this
Right.
clear?
Yeah, yeah. I think
So so
the
so.
sorry.
Hmm.
So
So
please say.
this is kind of the curve, right? Now, to coming back to your question, that how this regime has changed, right? It's you observe this over certain lookbacks, and you kind of estimate it based on what values of correlations you're seeing, or you one of the ways, I mean, I'll not go into it, is you can classify how the market is moving, how the walls are moving, into 3 or 4 regimes, and you kind of see whether the characteristics are matching for that. Okay, but for that you need this analytical framework, which kind of tells you that whether you're going to do it. I know I've not answered your question satisfactorily, because this is a more advanced topic than what we are discussing right now. So I'll park it for later. I'll
Sure.
stop here.
No, sure. Thank you. I have Alok as well on the speaker panel if he wants to add anything. Otherwise, we'll also invite any audience members who want to ask a question on whatever we've been discussed or pitch in while Alok contributes. Please, I'll accept your requests. Alok.
Yeah, I mean, this is something that we do. Simulations are a part of the whole game, right? I mean, whether it's strategy or whether it is just pure option simulations. Part dependence is what Roy talked about, and that is absolutely critical, right? So we run a bunch of Monte Carlos all the time, correct? We build a strategy. We'll assume that you know a backtest is just one path that the Nifty took in the past, right? Does that tell you that that is going to be the exact path that Nifty is going to take going forward? Probably not, right? You might have some clustering of drawdowns, you might have some clustering of payoffs, and that path is going to be dependent. And you want to check for the robustness of your strategy if it takes a different path, right? You can assume that the returns that your strategy have generated are fairly similar to what you have seen in the past, right? Because the past has seen fairly large-sized events, right? We've seen demonetization in your backtest. You've seen Russia-Ukraine war. You've seen COVID. You've seen pretty much anything that can possibly happen in the future. You've already seen in the past. Maybe there is something out there that might be even bigger than what we've seen in the past, but it's a good proxy for what you have seen, right? And if you assume that those daily returns that your strategy has seen are probably going to be replicated, but uh, not in the same sequence as they have happened, right? You might get COVID followed by Russia-Ukraine war, followed by high inflation, followed by interest rates rise, right? I mean, all of that might happen in a cluster at the same time. And so, if you take your returns that you have seen in the past and simulate a bunch of different paths using Monte Carlo simulations, your starting point and ending point are going to be the same, but the path it takes to get there are going to be different. And then we typically will take a whole bunch of these simulations, simulate maybe 10,000 paths, and then say what is the 95% confidence that you're going to be within a certain range, and that's your drawdown behavior of your strategy. I don't know if that answers what Roy you were trying to get to, but that's what we do all day long with all our strategies any which way.
Absolutely, I agree with you.
So one thing I'd like to add here is when we talk about these simulations or Monte Carlo, or be it any other form of spot wall correlations that Roy was talking about, there are always inherent assumptions in baked in it, which are important to be looked into. So for example, what Alok just talked about, even if you run a Monte Carlo simulation on your backtest reports, you are kind of assuming that you have seen all the potential spot wall correlations that Roy was talking about within your backtest period. And when you shuffle those things around, your Monte Carlo simulation is going to give you a very quick and very realistic estimate of what potential paths it may take. Now, it may not be a purist approach wherein you actually model your spot vol correlations and then regimes and then really reprice your options, but it is a very quick and dirty and a very, I would say, a practitioner way of turning around your backtest into a more robust mechanism. So, but it's always good that you know what your assumptions are in your simulations, because otherwise some of these things might be in the blind spot and may blow up. Now in this case it's a very simplistic example that we have discussed, but as a practice, knowing your assumptions behind any of your simulations and backtests really go a long way. um, I don't have any speaker request. So Roy, should we go on to the next uh, topic on this?
Sure, sure. Okay. So, yeah. So, coming back to the point, right? So, this smooth equity curve, right? So, you would have seen that there are a lot of smooth equity curves which are being presented, which kind of don't
Man, you've
give
seen
you a
45-degree lines, man.
huh? Sorry.
I've seen 45-degree lines.
Yeah, yeah, yeah. 45-degree with lever up as much as you want, right? Yeah. So Ankit, I want to borrow a term from Nicholas Taleb's book. It's called silent risk, and I'm going to try to explain what silent risk is, right? So going back to our example where you were selling strangles, right? And you knew that in your back test it has never kind of hit those levels, and you are always making money on the decay or whatever you want to call it, right? So this kind of equity curve will show a very, very smooth line, right? And it will never show you that it has a drawdown. The problem with this kind of trade is, you know uh, it has some risk which is known as silent risk, which is sitting out there. The risk is still there, but it doesn't show up on the data. Okay, what do I mean by that? Now if you had backtested your option strategy from 2017 to 2020 before March, right? So let's say you did till December 2019, right? So it's not going to show up, and then suddenly it showed up on 2020, right? So it was a one-off event. It was, if you want to call it an outlier event, it was an outlier event, and it kind of broke your entire assumption that this strategy is a great strategy, right? I mean, because it kind of broke the fundamental premise of it. Now you might argue that okay, but every strategy has kind of a risk with it, right? That's why we trade and make money, right? Otherwise no one would have been able to make money. The point I'm trying to make here is you need to bake in these assumptions into your P&L, right? So typically, conventionally, what happens is when you're backtesting, right? The probability of making money is just defined by uh, how many trades went right, divided by how many trades you took, right? I mean, that is the classical way that's known as a frequency probability. That what is the frequency in which you're making money, or what is your hit rate, right? And then you have a risk to reward kind of a payoff, that on an average, how much are your winners making versus your losers, right? So it's fair enough, right? But when you look at something like an option, and you have this kind of a setup where you have what we call is tail risk, then you know those assumptions don't work anymore, because your data is not showing that large fall, right? So how do you kind of adjust for it, right? You know that your expected P&L is probability of making money multiplied by how much you made, plus probability of not making money into how much you lost. right? Very simply, I'm trying to define it. Now, if your losses are whatever losses your trades are showing, if you just take that, then you're missing this critical event, because though the probability of the event happening is very very low, the impact of such an event is extremely high. Okay. Now, so probability multiplied by the PNL you're going to incur by losing is going to be a fair number. It's going to be a decent number. Now, why do I talk about it? And a lot of people would cut me here and say that, okay, I'll use stops, right? Or I'll use, let's say, I'll have the right position sizing. These are fair points. I mean, I'm not refuting these points. But what I'm trying to say here is, whenever you're using a stop or whenever you're using a position size, you're there are two problems. When you're using a stop, you're assuming that you're going to get out of the trade on that at that point, which your backtest might show that, yeah, perfectly you can get out. You use tick data and you find out that you can get out at that point, right? But as you scale up this kind of a strategy, and this as this strategy becomes more and more popular, then what happens is a lot of people are doing the same trade. Okay. And imagine, all of you are seated at in a theater. I mean, and there's a fire breakout, and then the number of people sitting in the theater is critical for how many people survive, right? I mean, if you have a packed, jam-packed kind of a theater, then not all people are going to come. If it's a severe fire, then not all people, well, I hope not, but not all of people are going to make out alive, right? It's a similar situation over here, Ankit. Your trade is not dependent just on you, it's dependent on how many people are doing this trade, and this is what is known as overcrowding, right? Now you have to account for this kind of an overcrowding using some probabilistic measure that, okay, because my trade size is this, and I have a stop here where a lot of people might be putting stop, I may not be able to get out at this point, and my loss might be a bit more than what I'm estimating, right? That is one problem of this kind of a trade using stops. The other problem is when you're trying to scale up this strategy, right? You The complexity of the trade is kind of increasing with your scaling up, right? And the position, the position size you take is kind of non-linearly increasing the complexity of getting out of the trade. So what do I mean by that? That, if you did a trade with one lot, then the complexity is much lower and than if you did 10 lots. But if you did 100 lots, the complexity from 10 to 100 jump is much more than 1 to 10, right? So what happens in a short gamma trade when you're looking to get out, the market is moving very very fast. You are kind of asking for liquidity, right? You want to get out, so you are asking, you're a liquidity seeker. And when you're a liquidity seeker in a stressed market, the complexity of getting out becomes more and more difficult. So I'll probably not call it risk of ruin, because you're not getting ruined by one trade if you're sizing it properly. But what I'm trying to say is these are kind of the silent risks which are there in this kind of strategies, which are equity curve is never going to show you. And this is what I mean by optional analytics, that you can do a lot more than what a backtest can, right? So that's my point on this. I'll stop here, and if anyone has any points over here, please feel free.
What I'd like to, sorry, was going to say, was like to add was, one of the things in a back test, typically with or without options trading, is one of the things we aim to do at ourselves, our side, is to figure out where would it break. The motive is like when we started this small discussion, we said 45-degree backtests are very common, but then those are not realistic. So where would it break? And how to break that backtest is what your research problem should be, and not the other way around. That how do we create a very beautiful looking backtest? But Roy, I have a very simplistic question on this, right? So a lot of times, and almost everybody who's done a backtest would have made some assumptions about slippages, which has inherent, punitive charges on your backtest, because in real life trading, you may get a better fill, you may not get a better fill. The markets may move really in your direction, may skip your stop loss, and so on and so forth. So, it has much more complex nuance. But then when you use a slippage, you're inherently penalizing your PNL. Now, the magnitude of slippage might be such it may not penalize the PNL at all, or it may be big enough that it just evaporates most of your edge or most of your PNL. So, what do you think of this, simplistic way of using a slippage as a way to kind of not probably doing what you're trying to say in a very, in a more evolved manner, but let's say somebody who's starting out, or who's trying to get things right and using slippages, how far or how close is that person from what you think should be the way it is to be done?
It's a very good question, Kit, and it's not. It doesn't have an easy answer, and more than slippage, what I'm trying to say here is, you know, an option price is non-linear, right? So when you're short an option, it is very difficult to estimate, the what at what price you want to get out compared to a future, right? In a future, it's kind of a linear movement. Okay, the spot is moving and your future is moving, so you are kind of dependent on the bid and ask. Where your bid and ask is, you kind of get out over there, maybe at a depressed price, maybe at a good price, what you talked about, right? But what the complexity for an option is, for there could be a momentary spike in the volatility, right? And because you sold a strangle and one of the legs of the strangle is coming close to money, then not only your vega, which is the sensitivity of the option to the volatility, option price to volatility, it is increasing as you move towards ATM. And also your gamma is increasing because as you come close to ATM, the gamma is also increasing, which means the sensitivity with respect to the spot movement is also increasing, and the vol movement is also increasing. If both are in the same direction, then the depression in price will be much more than you can think of, right? So uh, that is the kind of non-linearity I'm talking about. And for that, to answer your question, like, I mean, how does a new person, or maybe like anyone who's been in the market also, right? I mean, would do is, you would need some kind of a tool or a model. By model, I don't mean a very hi-fi or sophisticated model, but which kind of estimates that, no, these non-linearities. The human mind is not very capable of, understanding non-linearities. I mean, because we are kind of attuned to something like a futures trading, where okay, if the market falls 100 points, you lose this. If it falls another 100 points, I lose this. And we tend to think we are kind of getting anchored to the first 100-point move, because that is what I lost in the 100 points, right? For an option, it doesn't work that way. For an option, the PNL kind of non-linearly increases, or it kind of your MTM kind of non-linearly goes down. And for that, you need some kind of a tool or a toy model to play with, to kind of check, what kind of scenarios will really hurt you. And that is a much better approach than looking at past prices, and just assuming that, okay, I'm not going to lose on slippage based on this. That's my take. I mean, if anyone has
So,
any thoughts on this.
yeah, thanks. I'm gonna ask the audience again if you have any questions, or Alok, if you have anything. I know Prashant. Oh, Prashant
I
is
have
on.
a little bit of a different take on that, Roy. Right? If you're running one strategy, then yeah, there is a problem. If your position sizing is out of check, then yeah, you have a problem, right? Not understanding the non-linearity. But I mean, if you're running a diversified set of strategies, and if your position sizing across strategies is okay, then at some point, yes, I have lost money, and yes, I do understand that my gamma is accelerating, my position is increasing when the trade's going against me. Even if you understand all of that, right? If your system says exit, you're going to exit any which way, correct? So to me, that's lesser of an issue, right? Slippages, yeah, it does affect it. Exit liquidity, you could have a very large size on an illiquid strike and you have no exit liquidity. If you know the underlying Greeks of your position, then well, there's enough liquidity in some of the rounded strikes, right? I mean, on Nifty, for example, say you're stuck in a 15,350 call or a put, right? And the market goes to 15,000, there's going to be enough exit liquidity on the 15,000 put. You can neutralize your risk any which way. There are going to be liquid options at some strike. So I don't see what the problem is. If you like, every now and then you're going to get stuck on a bad position, right? If you're shorting wall, you got to understand that 2 out of 3 times you're going to make money, 1 out of 3 times you're going to have to manage, right? The management can be in the form of adjustments, or it can just be an exit, correct? Either scenario, even if you exit, right, you don't have to exit your particular position or your particular strike. I mean, there are many ways of exiting your position if you know the risk that you're carrying.
That actually
Absolutely.
adds.
Sorry. Go ahead, Ankit.
Naini Roy, you speak.
Okay, so yeah, I totally agree with you. I mean, first of all, diversification does help in kind of toning down your losses on a portfolio level. And the other thing you said is a very, very important thing. I mean, whether you want to get out at rounded strikes and those specific strike. Alok, my point was also on the stop losses being used on particular strikes, right? So, you know, I, I mean, it's debatable that whether you should use stops or not. I personally don't kind of like using stops or on these things. But yeah, I mean, as you said, right, there could be a hedge, or there could be some other strike at which you kind of get out and you kind of manage the position in that way. So I completely agree with you. I think I got a little carried away in talking about stops and kind of getting out in the same way we got out in futures.
Yeah, I
Yeah, I
mean,
think.
worst comes to worst, futures are always active, right? If an option is frozen for whatever
Yeah,
reason, and there's no exit liquidity on that option, your biggest risk if you're short options is delta, right? I mean, neutralize your delta and then
yes,
forget about everything else later, right? You can
absolutely,
figure out all the other risk later, but delta neutral ho gaya, then you're good to go, right? At least you'll
absolutely.
survive. You'll survive.
Uh, Absolutely, it's a great point. I mean, and that's why I think, Ankit, we keep stressing about knowing the Greeks, right? I mean, if you know what are the Greeks of your position, and you will, it's a very common knowledge for anyone that delta is kind of the biggest driver of your PNL, and that's why you have delta neutral, delta hedge strategies, and like, that is having a much bigger effect than all the other effects. And probably if we have time, we're going to cover that in our next section. But yeah, I mean, if anyone else has any kind of thoughts on this.
Yeah, actually, I would like to add one very important thing that you talked about. That see, the exit liquidity comes into usually a place wherein you are either trading institutional or a larger size, or there's a lot of crowding in one particular strike, and that's why this PNL attribution exercise that a lot of you and us we talk about a lot helps a lot. What is an SL? SL is just trying to mitigate the risk. It may not be that you have to exit that particular strike. If you know that you don't want to carry your deltas or vegas, whatever the Greeks might be, you can just hedge out, just like you guys are saying. So this starts applying when you start having a larger position set in a single position. When people are starting out, they might not have a lot of options, but I guess everybody wants to start with 1 2 lots or wherever their starting point is and grow to a larger size. So it's important to keep an eye on that target to start inculcating those kind of concepts and understanding when you're starting out, and then later on you don't have to really repivot and reset all of your expectations. With that said, I have a few, Roy, if you don't mind, I have a few speaker requests. I'm gonna ask them in the same order as I've received them, and then we'll most likely, it would be great if you can answer those questions. So the first request is coming from speaker called Option Control. Uh, can you speak? option control. Okay, I'm gonna move to while they can't speak. Next is Naresh. Naresh, you have a question?
No, no, so that was done by mistake. So I go to listener mode.
All right, thank you. Option control. Naresh, how about you? If not, we'll have. There are two more, Kevin and Rishi. I'm gonna bring them on stage. Naresh, last chance for you for now. All right, Kevin, you're next.
Okay, so I just want to further collaborate with that. Means whatever these guys are talking about. Let's say when you are trading in some institutional kind of setup that I am trading. So you have very large position on maybe some kind of any spread or any trade structure. Let's not get into that, but you have some large position on across the strike on maybe one expiry or two or three expiries. Now there is a liquidity stress in the market, and I want to immediately exit out my position. I am not going to get enough liquidity so that I can exit at maybe my defined loss level. So what we used to do is we further break down our option position in five component. Let's say uh, my all over position vega is this much, maybe it may be positive or negative vega, my gamma is this much and my delta is this much. So what I want to do at that point of time is, let's say I don't want delta risk because market is moving very violently and I may not exit, so I will hedge delta whenever in very cheapest way, meaning whatever strike or whatever expiry I get very easily in. I get my size easily moved out, so I will hedge my delta risk with that. So maybe I also want to hedge my vega risk, so I will do that, but not necessary by closing out my existing position, but taking out the new position that can complement my risk. So, and I think this is the best way. And whatever we have seen in means last two expiries, so Bank Nifty is moving very violently. You cannot exit. Means if you have some thousands and thousands of lot in current expiry, you are not going to get filled. So that is what I think. Actually, it is what actually saves me in last expiry. So this is what I want to.
All right,
So it is means.
thank you. Thanks.
So what we used to think means for I think including myself is, if you have position in it is moving against you, so you have to immediately exit out. Otherwise, means if market crash against, maybe I have long position in option and market. Sorry, short position in some put option and market is crashing and crashing. I have to exit to means to means faster I get exit, I will book my loss. But whoa, I don't know, means we don't know keep for if you are trading with many lot sizes, you are not going to you are going to hurt your PNL much bad. So that's what I talking about.
Right.
So it is doable, and I
Okay,
think
thank you.
everybody I think one should also try to capitalize on that.
Very useful. Kevin, by the way, he's a prop trader. He trades for Marwadi Capital, I believe. So very practical insights.
Yes.
Thanks, Kevin.
Yes.
Rishi, you are next. Rishi, can we hear you? You had a request as a speaker. All right. I don't think we have Rishi being able to speak. We have Sandeep next if he wants to speak.
Hi, Ankit. Thanks for the opportunity. I had a question not related to what has been discussed, but slightly broader trading question on options. And so, large part of the janta who's there on the Twitter and retail trades very small lots, and generally they are trading options more as a delta play or a theta play rather than actually getting into Greeks and really doing back test and Monte Carlo and finding out the viability of a potential trading system. So my question basically was, with that background, my question basically was that if somebody wants to really do a pure Greeks play on options. To run it efficiently, given the
Sandeep, sorry,
liquidity.
Sandeep, I'm sorry to interrupt. I'm not sure if it was me or if it was the audience. Could you repeat the last 5 seconds? I think your voice was breaking.
I was saying that my question is, in your opinion, what is the good size for somebody to start with when they are looking to trade option Greeks on, say, Nifty or a bank Nifty, in terms of ability to really delta hedge on a live basis, or hedge other Greeks on a live basis, given the available liquidity and other constraints? What is the good size for that to do efficiently?
So, Sandeep, before Roy speaks, I know I can have a very quick answer on that. So, by hedging, let's say if you have a single short call or short option, you have 50 delta short. All you need is a 50 delta to hedge that out, the delta. If you're shorting two calls or two puts, you can hedge out with single futures exposure. So even with a couple of lots, you can actually hedge out your exposure by buying or selling some combinations of OTMs or futures. So I don't think it's that difficult to execute
नहीं, वो
given
तो
the
नहीं होगा ना अंकित. Sorry to interrupt, but अगर spot 2% move हुआ, then you cannot change your future position because now delta is from 50 to 55. So what you do now?
Yeah, so first of all, 2% may delta will go from 50 to
I'm just
95.
taking I'm
Right?
just taking some random numbers.
So
Yeah.
if you think about it, I don't think whenever somebody's talking about delta hedging, they are not talking about the 50 to 55 move also requires that hedging. There's always this wiggle room of hedge rebalancing of how frequently you want to hedge it out. But in my experience,
But even say 50 to 75, or like then 50 to 60, which I think so start to become a decent
you buy an
number.
OTM put, right? You buy an 25 delta put, and then you're gonna hedge out your 25 extra deltas that you've accumulated. If you're short call and you're going minus 75 deltas, your position is moving against you. You can buy a short put, and this is gonna hedge out, or short call. Buy put or buy call depending on where your deltas are moving. But I'm gonna stop. I'm gonna have Roy or Alok pitch in on this part.
Ankit, you're absolutely right. Right. I mean, to us, option chain is a continuum, right? I don't think position size has anything to do with first of all, Sandeep, you're talking about hedging or trading Greeks. I mean, Greeks are not a trade, right? It's not. I mean, Greeks are your underlying risks in your option trades. One of the things that we keep talking about, right? So we do a whole mentoring.
Sorry to interrupt again. Just to clarify, suppose I'm not trading delta at all, and I have a view on wall going up, so I want to trade only wall. So I want to be absolutely delta neutral because my view is only wall going up. So what I do is I sell options and I cover my delta in say spot or future or whatever is possible.
First thing, if your view is long wall, you'd never be short options, right? I mean, you'd have to be long options for you to have long wall position.
Yeah. Sorry, I meant long options. So I basically need to neutralize the delta. So, or somebody else is having some other view on the Greeks and wants to trade only the Greeks.
Why would you want to hedge your deltas? If you're long options, you're long wall, you're long gamma. If the market is moving, wall is expanding, right? And the market is moving, you are getting gamma that you can basically trade around. So you can choose to neutralize it, but I mean that's the essential idea behind long options, right? You have convexity playing in your favor. So let's say you are how would you do long wall? You're probably long a straddle, okay? Or you're probably short calendar or some form of something that gets you long volatility or long vega exposure, right? Now when market is moving and volatility is increasing, right? If you have a long gamma structure, then you are essentially going to use that long gamma that you have on your book and effectively scalp away. There are so many different ways to gamma scalp. Position size has nothing to do with whether you can gamma scalp or not. that make sense?
I think Sandeep got lost or something. We can move on. I know, Roy, do you want to have
Ankit,
anything
if I
to
can just
respond?
add, I can just add a
Yes,
simple,
please.
say, shorter 15800 straddle, right? And he wants to keep it delta neutral all the time. Market moves to 15900. What happens to this 15800 straddle? Now you have negative deltas. You let go of that straddle and you sell a 15900 straddle. You're delta neutral all over again. You can do this with as low as one lot. So, like Alok is saying, keeping delta neutral or keeping certain Greeks within certain ranges has nothing to do with the size of your position. If you are doing 50 lots and the market moves by 100 points, your delta might go out from 0 to maybe minus 50. In that case, you buy a future. Market goes up, you buy a future, right? And you bring your delta to 0. But if you're doing one lot, you just shift your strike and you're done. I,
Right. Yeah, that's what. No, Prashant, that makes sense. That's what I think I opened with saying that lot sizes have nothing to do with the capital size. You can easily manage your
Correct.
Greeks
You're absolutely right,
even with
Ankit.
two lots or whatever it has. Roy, do you want to pitch in or do we want to go to the next question? Or Roy, you have the stage to, if you want to cover the next topic before we go to more questions, you're fine by that. So your call.
Yeah, let's take questions. I mean, let's stick to this. And I have no further comments on this question, but if there are any other questions, let's take them.
All right. So Rishi, I'm going to give you another chance. I know you were not able to speak last time. Let's see if you are able to speak. Otherwise, we'll go to the next request, which is of Bala. Rishi, can we hear you? Doesn't seem like the case.
Yeah,
Oh, there you
I
go.
don't have any questions. I
All
don't
right.
have any questions right now.
All right.
So,
Bala,
no,
let's
that
see.
is available.
Bala, do you have your question? It doesn't
Hello. Hi.
seem to
Hi.
be the.
Am I
Oh,
audible?
yes, it is. Yes, Bala,
Yeah.
please go ahead.
Sorry. Quickly, I'll take 2 minutes. My question is the advantages or disadvantages of doing synthetic futures versus direct futures. And second, if there is an advantage of using synthetic future, is it wise to use weekly or monthly?
So I can take this because I do trade synthetic futures. So the reason I do that, and again, it might be more nuanced than just simple what is better or what is not. So one of the reasons, so when you use a synthetic future, you're buying a call and shorting a put or the other way around. So you're neutralizing all the Greeks and you just have a pure delta exposure. Now the difference between a futures and a synthetic future typically is, and I'm assuming you are trading weekly options and monthly futures. So your duration changes. Your futures are on monthly, which expire end of the month, and your weekly, when you create a weekly synthetic, your weekly future is expiring on next week or Thursday, whatever the day is. So essentially, if you go into the pricing of futures and how the dividends and the interest rates play, on a theoretical basis, these are two different futures because they have different times to expiry. Time to expiry is not as sensitive on futures as it is on options, but nonetheless, but it's a very subtle difference. In my experience, either of them can be used if your aim is just to get delta exposure. Synthetic month end from a P&L perspective will not make a lot of difference to investigate it that deep. The only where the only place it makes a lot of some of the difference is if you are the cost, right? The futures are charged the SEBI, STT, and other charges or on the full future contract value, whereas options are on the options premium. So there it changes a bit. But yeah, I think they are very similar, and I would like to stick to some of the options trading topic, the topics that Roy has brought in. But thanks for that question, Bala. I'm not sure if anybody on the panel wants to add to that.
Yeah, there is one other advantage, Ankit, of doing synthetics versus actual futures is the daily mark to market on your futures, right? Options don't have daily mark to market. So if you have a position where you're taking fairly large size positions with not a significant amount of ledger credit, right? A daily mark to market on your futures can play havoc with your ledger. With options, there's no impact until you exit.
Very interesting. I didn't know that. Thank you. All right, we can go to the next speaker if that's okay with the panelists. Krishna, can we hear your
Yeah,
question?
hi. Am I audible?
Yes, you are.
Yeah, hi. So I am kind of a beginner, so I've been trading since 6 months. So my question also might sound a bit dumb. So what my I have seen in my experience is like whenever I do a trade, I take a trade based on the Greeks or the OI, right? So suppose Bank Nifty at 33,000, and I see the highest number of put writing happening at 33,000, and I do a sell that put considering that market will not go below that. And what happens is like I see a support there, but suddenly HDFC Bank or ICICI goes down, and Bank Nifty breaks the support. So how does the Greek takes place there? Because does that bank movement takes the higher priority than the options writing? So
Um, I'm not sure if I followed the question. I don't know if Roy Alok or Prashant has an answer. I couldn't understand the question well.
I guess it's the age old question of the tail wagging the dog. I don't know if that's the question. Whether the option price. Let me try and rephrase the question, and maybe
yeah,
you can
so
say if
can
the
I
question is right or not.
can I just repeat it if I'm
Yeah.
No, my question was like when I see the Greeks and suppose I take option like to sell 33,000 put where the highest number of OI and OI is there, so that acts as a support for that particular Bank Nifty option, right? So suppose at that point of time, suppose HDFC Bank or ICICI Bank goes down, right? So it breaks down that 33,000 support and goes below that. So my question was like, how does that OI behavior, like open interest we have in that, right? So, I mean, how does that behave when the specific bank goes down? I mean, how does that support takes place?
Can I try and answer that, Ankit?
Yes, yes, please, Prashant.
Okay, so it seems to be common knowledge that large OI build up at a strike will be a support. But think about a situation where if the large OI is at a place where the overall market has got negative gamma, then with every point move down, your market is going to have to sell more futures to hedge their risks, to hedge the delta risk. So if your OI is, say the market is trading at 34,000 and 33,000 is your large OI number. If the market gets to 33,000 and we are sitting in a environment where the overall gamma on that option chain is negative, then every move, every 20 points down move on Bank Nifty is going to have to be further sold into for hedging the delta risk on that position for the overall market. Okay, and in that situation, that I mean, none of those OIs are going, none of those large OI strikes are going to be any sorts of resistance or supports at all. The market is just going to hedge the delta risk out there and keep selling into that situation. So it's very dynamic relating to how the overall option chain is behaving. One particular strike is unlikely to create a situation where it's going to affect the entire movement of the underlying. That would be my take on it.
Right. Thanks, Prashant. Uh,
Yeah, thanks.
I'm gonna take one more question from the previous set of people who were on. I think Ketan was on the stage first,
Yes,
and
yes,
then
yes.
we'll take another topic on, and then come back to the questions. Sure,
Yeah.
Ketan, please go ahead.
Yeah. My question is like, I want to ask if anyone to do weekly intraday option trading in weekly expiry, then is it a good idea to have to trade with debit spread or credit spread, um,
Okay.
focusing on intraday option trading?
All right, Ketan, I'm going to answer that and then go to others. So I don't think this is the topic of discussion, guys. So for other audience as well who's listening in, I'm gonna answer this once, right? You can trade it in credit, debit, naked, put, backspread, butterfly, fly. Any kind of structure is good or bad in any format of trading. What matters is what you're trying to achieve out of it. So the notion that put spreads are better than call spreads, or back spreads, or butterflies are better, strangles are better. It's not correct. The answer is it really depends on how you're trading, what you're trading, what's your duration of holding, and so on. What's the environment? So these questions, come a lot more often than what we like them to. But please understand, there is no one answer that would fit all. So I guess, in the interest of time and interest of the topics that we intended to cover, Roy, I would give the stage back to you so that you can probably talk about some of the other ideas you have, and then we can circle to some of the more audience questions. Roy.
Sure. Ankit, the next topic I'm going to talk about is a little advanced. So please bear with me if I'm going a little off tangent, and please kind of stop me if you think that that's going way away, digressing a lot, right? So we have talked about the ways, kind of the ways where we are analyzing options and the standard ways of doing backtests, and what are the kind of inherent risks an option has, right? uh, there is actually a little more to it than what it shows. And I'm going to talk cover that, taking a cue from Alok's point about the option chain being a continuum. I mean, I really like that sentence what he said. And I'm going to talk a bit about option chains now, and what all insights we can derive from an option chain. See, the thing is, a single option does not really tell you much about the market. I mean, it can tell you that where the quote for a certain strike of an option is, and you know what what price you're going to pay to enter the option, and what is the implied volatility for that option, and so on, right? But if you look at the entire option chain, which is showing you the different prices at a particular expiry for different strikes, and then for different expiries for different strikes, then you get a whole new meaning of the what the market is saying. And this, in quants, or it's not really quants right now, it's become very commonplace right now in the industry, is understanding what implieds are, right? So let me start with a very simple kind of understanding, and then we'll move to the higher and higher order levels, right? So when we are talking about implied, everybody has heard about implied volatility, right? Which means that the market is expecting that from now on, when the quote is, or when you're entering the option, up to the expiry, the spot will take some path, and it will have some kind of returns every day. And then when you square them and sum them up, take a square root, you are going to get the volatility which it is being quoted right now. I mean, so the market is saying that, okay, from here to expiry, the market's going to be this much volatile. Now, as an option trader, or as a little bit quantitative nature of your trading, you are always trading against the implied, right? So if you think that your implieds are going to be less, the volatility is going to be the actual volatility, which is known as the realized volatility, is going to be less than what it is right now, then you're going to sell those options, right? I mean, in very loose terms. I mean, ignoring that your deltas and all, you'll try to delta hedge and so on, right? If you're assuming that the volatility is going to be more than what it is right now, then you're going to kind of buy, right? So that's the first order kind of implication of what an implied is. So market is telling you this is the implied volatility from the quote and option, and that is what a single option is telling you, and you're betting against that. What it also tells you, and then when you look at a chain, is how the entire distribution of your prices are going to be, and that is what is known as an implied distribution. Okay, now you know that from your past basically returns, if you take, let's say, daily nifty returns, or weekly returns or whatever, at whatever level you're taking the returns, you know that the the prices or the returns are distributed in a certain manner. Okay. Now, everybody knows that it's not a normal distribution, which is a typical bell curve, and it's a little different from a normal distribution. And the distributions are such that at the tails of the distribution, you have they are a little thicker, and also the distribution is skewed. Now, what do I mean by fatter tails or thicker tails? It means that the probability of the market moving to the tail or moving by a large percentage is more than what is kind of implied by a normal distribution. Now, let's not go into the distribution part so much. I mean, the technicality so much, because it's difficult to explain this in spaces. But what I'm trying to say here is, from historically, from those returns, and from whatever you have, your historical analysis or whatever your experience is, you know that, okay, the market has a certain kind of a behavior which you show by a distribution. Also, what quants help you is, from an option chain, you can basically find out what the current distribution is like, or what is the implied distribution. Okay, how do you do that? Let me quickly kind of try to tell that. Let's say you have an option, a 16,000 strike call option of Nifty, and a 16,050 call option of Nifty again. And then you have two prices, right? So let's say the current price you have is 100 and 110 for the 16,000 call, and 1650 is 100. Okay, I'm just making up prices. Then the difference between the prices of the calls tell you something, right? So typically, in any quantitative finance, or any kind of payoff where you have at expiry, you can break it down into probabilities, right? So assuming that 16,000 and 16,050 are very close to each other, all right, it's still a 50-point difference, but assuming that that 50 points is too low, right? Then either the market closes above 16,050, or it closes below 16,050, right? So you have kind of a bet that if it goes above 16,050, then how much you're going to make? You're going to make 50 minus, so 16,050 minus 16,050, minus you have paid 10 for the call, so you're going to make 40, right? uh, Clear till now, right? So yeah, so you're going to make 40. Now, obviously, what is the now if I ask you, what is the probability of the market closing above 16,050, then roughly, and I'm using the word roughly because this 50-point difference, roughly the probability multiplied by your payoff, all right, should be equal to the price of the option, right? So you are making 50 at expiry because that is your payoff, and you are paying 10 for it. So 50 into P should be equal to 10, right? So that's a very simplistic example, but I mean, please try to bear with me what I'm trying to get here now. Now, so the probability of the market closing above 16,050 is 10 divided by 50, or zero point 0.2, right? So now, what does this probability tell us? Okay, so now this probability is kind of giving us some insights that, okay, there's a 20% chance that the market will close above 16,050. Now, assume that you have another call spread which is at which is 16,050 and 16,100, right? So let's say the price of the we discuss the price of the 16050 call is 100, and let's say the price of the 1600 call is, let's say, 95, right? Hello, sorry, any can I continue?
Yeah, Roy, continue. I think Alok bhai might have. Yeah,
Right.
Roy, please continue.
Right. So if I sold the 16050 call and I bought the 1600 call, then I'm betting that the market will close below 16050, right? So the probability of the market closing below 16050 is 5 divided by 50, or 0.1, right? Now, if I ask you what is the probability of the market closing at 16050, right? Then it is basically the call spread you bought minus the call spread you sold. So basically it's kind of a butterfly, which tells you what is the probability of the market closing at 16050. I know it's a little difficult to understand this mentally. I mean, probably a diagram would have helped, but try to appreciate the fact that you bought a call spread and you sold a call spread, and the point where the two meet, which is 16050, you are kind of getting a probability of the market closing at that point with certain assumptions, right? So this is basically known as an implied probability of the market closing at a particular price. Now, this we could do all across the option chain and find out all the probabilities which we have, right? So what it is going to give you is going to give you a probability distribution. Okay, and what does that distribution tell you? It tells you that if the market is, what are the chances of the market going up by 5%? What are the chances of the market going up by 10%, or it's falling by 2%, falling by 3%, right? If I do it all across the market chain. And then you get a completely different insight from option chains that, what is the market really implying, or the market telling you that this is the probability. Now this is kind of important because let's say you have some other analysis through your technical analysis or something that which tells you that if the market falls, let's say, 300 points, it's going to fall another 200 points. It's classic technical analysis. A lot of stuff like this happens, right? I mean, if it breaks an important support, or if it goes down 100 points, it's going to go down another 300 points, right? So it's kind of conditional in nature, right? Which we bake into a lot of technical analysis, right? So but there is no way to quantify this, and that's what an option chain is going to give you, right? So the point I'm trying to make here is, when you have a new way of looking at things and you complement with your current analysis, you can get a much more quantifiable technique. For example, let's say you say you have historically seen that the tails of the distribution are fat, but right now, and the market, if it goes to tail, it kind of goes more, and it kind of gets, things get kind of worse from there. What this implied distribution is going to tell you is how much the tail is fat by, right? How much, what is the kind of the kurtosis, or what you call the fatness of the tail, I mean, to say, tell it in simple words, right? And that is kind of important, because then you're like quantifying that, okay, this is a degree of fatness of the tail, and I'm going to take a trade if this fatness is below this level and above this level. This kind of trade is known as a kurtosis trade, right? uh, I mean, unfortunately, in this spaces, I won't be able to go deep into it. But what I'm trying to say here is, there is a framework which is available, which kind of tells you that, which quantifies this kind of a thing, and it can be married with other analysis, and you can take a trade based on that. Why is this important? Ankit, you of all the people have said a lot about Prashant. Can I just quickly complete this and then it'll be over to you? Sorry, I can see your raised hand. Yeah. So, look, what I'm trying to get here with is, you know, uh, Ankit, you have talked a lot about beta, right? I mean, typically a trend following strategy, which is kind of a managed beta or a beta strategy, right? And it may or may not be alpha, right? Which is kind of giving you the returns. Now, this kind of a strategy where it is kind of conditional and it depends on what context the market is in right now. I mean, this can be a good diversifier from your current portfolio, which is more trading on delta, right? So if you are trading on delta, you're trading vols, you're trading the first and the second moment of this distribution. Trading skews and kurtosis is the third and the fourth moment, and it's kind of fairly, I would say that kind of diversifies because then taking a completely new perspective into the trade. And the other good thing is it may not be as crowded as a delta trade, right? So that's my limited point I wanted to bring over in the spaces, that there are different methods to imply from an option price, and it can provide you some insights which are typical, looking at just one option in silo may not give you. And I'll stop here, Ankit. I mean, I think I've spoken enough in this topic and for this spaces, and I'm ready to hand over to Prashant and anyone who has perspectives and ready to take questions.
Sure, sure. Thanks, Prashant. I know you wanted to say something. I also
Yeah,
know you're also in the.
I no, I really like the description of the implied probability distribution of the market moves from the option chain that Roy described. I actually had a question for him. Um, when he does this analysis, are you is there an importance that you give to an expiry that is closer in terms of the days to expiry, or further away, or how do you look at that when you're looking at these implied probability distributions? Um,
Uh,
and the reason,
yeah,
sorry,
sure.
and the reason I ask this is that a lot of the further out. So if I look at the monthly, I mean on Nifty, pretty much you can do this analysis only on Nifty and maybe Bank Nifty weeklies. So on Nifty, if you look at the 1 month and 2 month out, you pretty much get a very flat distribution, and a lot of this the distribution shows up only in the weekly. So just I don't know if you work with Nifty, Bank Nifty, or if you have, then what's your experience with doing this with that?
No, I mean, it's a great question, Prashant. I think, yeah, liquidity is definitely a concern. I mean, what all strikes you choose, right? And I mean, there's a similar problem which is faced in VIX as well, right? I mean, which are the ones which are kind of thrown out of the analysis, and which are the options which are kind of taken. My take is yes, it is definitely. I mean, it's a function of what time to expiry. I mean. I have limited experience of doing it on Nifty and Bank Nifty, but I was talking more of an approach. But yes, I mean, on a weeklies, this probability distributions will show up much better compared to, let's say, a bi-weekly or a 3 weekly, because of the liquidity. And maybe it shows up well on a monthly, but yeah, it is difficult to do it on a further out. Let me add something as little technical. I'm sorry, Ankit, I'm going a little technical here. So typically, an implied probability, the implied probabilities, if you join them by some kind of a line, it is not going to give you a very smooth kind of a surface, right? So you have to use something like a calibration or something like a best fit line, which is not a straight line, to kind of move them into a continuous framework. Right now, assuming you can choose the liquid options and you use something like, let's say, a cubic spline, then doing it on the option prices is not a very good idea. And the reason for that is, if you have a point in between, which is not, which is prone to arbitrage, right, which is not a correct price of the option, then you don't have a very good kind of estimator for that. What we do is this, and Prashant, this is a little generic. uh, we convert this option price into volatility, fit the curve into the volatility, and then we turn them back into option prices, right? And then compute the implied probabilities. Now, the reason for that is, when you convert them back to volatility, and when you and then you're applying black scholes or any kind of option pricer on this volatility, then it is already assuming that those arbitrages cannot happen. For example, with an increase in volatility, the price of an option should increase, right? This assumption is already baked into a black scholes. Or a butterfly cannot have a negative value, right? So it has to be convex in nature. So that is already baked into an option price. Now, obviously, if you move further out, coming back to your question, I know I digressed a bit. uh, Coming back to your question, the higher the expiry, let's say you have a 1 year, this, you will have a lot of noise in kind of predicting this. However, I mean, it's kind of a start, right? I mean, if you want to do it on SNP, I mean, it's much easier to do it on SNP, because the difference between the strikes is also much smaller. Plus, there is much active participation. But what I'm trying to get here is, it's an approach which kind of people can look at, and this kind of practical problems can be dealt with some kind of, I would say, mathematical jugglery, or we live with it, right? So yeah, I mean, I know I'm not given a very good answer to your question, but yeah, that's my take.
Thanks, Roy. And I'd just like to say, you said sorry for being technical. I don't think you have to be sorry. I think that's what we are, most of the audience here is for, some of the technical discussion. One thing I'd like to probably rephrase some or retake, re-say some of your words, is in practical aspects, probability, this implied distribution as implied from the option chain. You have all these tools to calculate it, and Roy spoke about it. Like, you can create butterflies on each strike to come up with an implied probability of where the market is pricing the expiry to be for that probability. Now, how would, like, a, let's say a discretionary trader or somebody who's not using systems, or maybe using systems but not automated, but like looking at 360-degree view of the market, monitoring Greeks and whatever, how can this be useful to them? So one of the things, trying to connect the tools to practical aspects is, a lot of discretionary traders have a view, right? And like Roy, you also mentioned technical analysis. It could be anything: your macro view, technical analysis, your system, and another algo, whatever. Whatever the feeder to your view is. Let's say you expect the market to be at 15,200 next week, or expire at that, or move at that. And then using this implied probability distribution, you can see what the market is pricing that probability as. So when you say, I expect the market to expire at 15,200, it should come up with a probability. Okay, my expectation is 80%, right? I expect there is an 80% chance the market will expire at 15,200. And now this probability implied, this option implied probability distribution can tell you if the market is in your consensus or not. So market may be implying a 15,000 expiry, or a 14,000 or 16,000 expiry. Using this kind of analytics tool, you can decipher that. And then, based on this difference where you think the market should be and what the market is implying, you can put a trade. And I think that's what a lot of volatility trading, or a lot of this dispersion trading is about, right? You have a view to it, and I'm just taking a very simplistic example of option expiry. It could be on your delta, I mean, on your Greeks, as in your IVs, or it could be skew, it could be on many things. But this is how the trading is all about. So you're a manual trader, discretion trader, you expect 80% chance of expiry at certain price, market is implying something else. Either you are correct, the market is correct, and you can put a trade accordingly. So that's where all of these things start baking in into practical aspects. So these tools that Roy has been speaking about so patiently for so long are all, it might look a little obscure to start with, but they all, once you start learning and applying them, they start fitting into each other, and kind of start giving you those insights of how we can utilize that. So that's all the a very dumbed down explain, like I'm a five kind of a version of what Roy spoke. I hope I did justice to what Roy was speaking. I'm going to move to questions.
Um,
If you
but
want to add on.
Ankit, see, the thing is that the implied probability distribution is not a signal for a trade. Because see, you might have the at the money butterfly giving you, say, on expiry day at 12 o'clock, the at the money butterfly for a 50-point butterfly is trading 8 rupees. Okay, now that your it's implying a six in like a 16% chance that it's going to expire at that level there, right? Or an 84% chance, sorry, that it's going to expire at that strike. Now the thing is that it's pricing it in that manner. So there's no edge really in knowing that there's an 84% chance that it's going to expire at this strike, because that's what the market is taking from you. But I guess what I really liked about what when Roy talked about is that it's the skew in that distribution or the kurtosis in the distribution that will give you additional information. Because you might see, when you plot this distribution, you will find that this is not always a normal distribution. This is like it's got various kinks in it. Market may be trading at 15,700, 15,725, and you'll see that the butterflies at 15,800 are slightly higher priced than butterflies at 16,650. They both are equidistant from the current market price, but there's a slight kink in that distribution curve there. Now that is a hint that is a little bit of a something the market is presenting, that there is some likelihood of expiring at 15,800, which is higher than 15,650. Now that could give you some sort of a trade, right? So it's not really I guess it's not really the highest point which is going to lead you to a trade, but these kinks in that distribution.
I agree. I agree.
Just a comment on the practical. How do you practically use
Yes,
this distribution?
I think that's very important, Prashant, what you said, right? These are not edges, or these are not some setups we are talking about, or some extra information which we have which will may help us make money. It is a framework which we are trying to present here, and these frameworks can lead to a lot of signaling, potential signaling. Now how we interpret that is on a trader, and that's how the person makes money, right? But it's important to know that a lot of young guys who have joined in, to know that such kind of doors are there which could be explored. And you should look at exploring this uh, in conjunction with the other analysis you're doing, maybe a technical analysis or a fundamental analysis, and it's going to broaden the horizon on your trading decisions. That's all I want to say here.
Right. So I think, let me clarify what I said, and I understand. The implied probability distribution is no way a signal. It's how you relative. Like you said, you look at the kinks on the surface, and those kind of arbitrages might be a very simple trade. What I meant to say was, let's say a discretionary trader who's not using this tool, and he's saying either through his gut or whatever, like if I have 100%, I have a signal which gives me 100% probability of my signal is 15,200 expiry, and market is implying something else, then I can put a trade. So it's like it's a conjunction into how other signals can blend into this information. I didn't mean to say this implied distribution itself is going to give you that trade. I'm just saying, if you are 100% sure for whatever reason, it's a very simplistic example, that market is going to be at 15,400, and market is not implying that. So either you can change your view, or you can put in trade and say the market is going to converge to my view. And for an index, this is very difficult to see. But let's say if you talk about stock options or stocks, wherein let's say if you have an insider information, market may not be implying the information that you already have. So either you may be ahead of the market through insider information, through models, through any of the other sophisticated, non-sophisticated ways to get a view. And this implied distribution can kind of give you another data point to match up with the view. That's what I was trying to imply. With that said, I know there was few requests on the stage. Saurabh has been waiting for a while, so I'm going to have him come up. And then the second speaker we've been waiting for a while is Fintwit, but Saurabh and Fintwit are next. Whoever can, Saurabh, can you speak?
Yeah, thank you,
Yes, we can hear you.
Ankit. So my question is to Roy. Consider for your institutional experience, suppose you are formulating any strategy and deploying it from tomorrow. So what are the factors that influence your decision making? Like means means the parameters you choose, the risk or the position size or the exposures. Means how you choose that as an institutional trader? What are the things influence apart from being a normal trader?
Uh, I don't know. I can't give out specifics over here. I cannot give out. But what I'll try to say is any institution, any financial institution, is trying to provide a service, right? So, in the financial markets, any institution is trying to provide a service. So, let's say you're a market maker, you're providing liquidity. If you're let's say a sell side institution, you are trying to pitch and sell some products to the buy side. And if you're a buy side, you're trying to kind of make money from the market based on your views and trying to run some portfolio for your clients and so on, right? So it will totally depend on what kind of institution you are. Based on my experience, what I see is, if you're a buy side, you are more of on a trade to trade and a view kind of a basis, which where you are basing your trade based on the what kind of positioning you have on the market and what kind of exposures you have. So as in the difference between a retail trader and an institution trader, I think is in an institutional setup, a trader is trying to look at the portfolio, look at a trade in conjunction with the portfolio or the risks it already has. Okay, and it is trying to put on a position based on that. A sell side institution is trying to manage risk, and they are trying to sell products to a buy side, and all they are doing is managing that risk using some kind of looking at the Greeks or so on. And for them the trade is not really their trade, it's a client trade which they are trying to hedge, and all they're making to make money is from the fee which they generate by selling the trade to the client and then hedging that to the to into the market. And if you're a market maker, then what a market maker is trying to do is provide liquidity without getting burnt. So I mean, they typically do not have a view on the market. I mean, they do have a view. I mean, it's wrong to say they don't have a view, but they would be more like looking at much smaller levels of differences and trying to get in and get out, or whatever mandate they have. So to answer your question, I mean, I think I've given a broad answer, but you know this is how the market players are positioned. If you're a HFT, you are looking at very small moves and you're trying to capture those small moves. So depending on the strategy and what strategy the firm has as a whole and the mandates the firm as a whole, they would like to position themselves. That's my answer.
Okay, Roy.
Thanks.
Thank you.
Thanks, Saurabh. Thanks, Saurabh. Thanks for your question. Finwit, can you
Yeah,
speak?
first of all, thanks Roy, Ankit, and everyone for such a nice and wonderful session. My question is for Ankit. Like this 920 straddle is widely discussed in social media, and many are following it on Indian market. Uh, have you tried it on doing back test or basically running a paper trade on a US market or any other market? And if yes, how is the performance?
So, I don't want to talk about the US option markets on this space. I think it's a very different market altogether with three expiries in a week. The whole dynamics are very different, and the discussion may go really off tangent. Uh, Neither, and the short answer is no. I have not really tried running it on US markets. One of the biggest assumption is US markets are slightly more efficient. So if there's an inefficiency which is being exploited in Indian market, you may not see the same thing in US markets. But it's a very general comment. Don't take my word for it. If you have the data, if you want to try out, even the 920 straddle, if you think about it, has a component of volatility and directional built into it, baked into it. So I'm sure some way or some method or morphing that methodology to some of the US markets may work out. But again, I am not in a position to speak about that. So I'd like to pass on that. Sorry about that. If you have any questions on the topic that we've been discussing today, we'd be happy to give you another question. Otherwise, we'll move on to the next request.
Thanks.
Thanks. Adi Raval, you next.
Hi guys, thanks for arranging this. Before I come to my question slash ask for guidance, will give a quick recap which would lead to this particular question. So I have actually done an engineering and then did MBA in finance. And then during my first job, which was in wealth management, I realized that financial concepts like book theory, it's quite different than the way practical trading works. And that is how I started with option buying, blew my account quite a few times, and then over time I moved to option selling, and all basis on that I wanted. Not to look at returns, but to look at probability of profit of making those returns. So then I incorporated the probability of ruin concept. So I still trade mostly non-directional delta neutral option strategies, mostly strangles. Try to manage my delta, using futures at times. And so this is currently how I'm doing my trades. And I've been following you guys since some time, and what I have noticed is that things are going great, but theta decay is not an edge. This is what I've realized, following you guys, and now I want to move, a level up. So I started with margin trading, then option buying, then option selling. I want to go to that next level, and also. Career wise, I currently am in a market risk role, and I believe that the best way to be in the middle of it is if I could make this quantitative trading a part of my career. If I am able to do this day in day out, if I'm surrounded by such people as you guys, then we'll do wonders.
Adi,
So
what's your question? Sorry to
yeah,
interrupt. Could you
yeah, yeah,
come
yeah.
to the
So,
question, for the sake of
yes.
time? Thank you.
So my question now is that I don't have a IIT degree background. I still want to make into this quantitative space as a career. So what advice would you guys give me? Like, what can I follow a CQF course? Can I do some courses which are suggested by some of these traders? What is it that I can do so I can understand more of the terms that you guys talk about, like kurtosis, skews, trading skews. I am sort of aware about the Greeks. I use Sensible to understand that and work around hedging and everything. But I want to move to that next level. So, what would you guys suggest me that I do in order to make into the quantitative, like make it a part of my career. Yeah.
Sure. Roy, do you think you can take that? Or maybe Alok Prashant as
Uh,
well?
Sure, I'll give a quick answer. Maybe since you're working in risk management, I mean one of the good courses I think, and I have done that, is FRM, Financial Risk Manager,
Mhm.
or by GARP, right? So I mean you can look at that course. It's going to answer all your basic questions like what is Q, what is kurtosis, and it's going to give you a basic level of knowledge, which I agree with you is required to do this kind of analyze markets in this way. Yes, I mean uh, y- there was a time where there was no books which would give you a lot of background to what how a quantitative trading is being done, but that has really changed in the last since 2011, when there was a website called Quantopian which came in, and then they kind of entirely changed the paradigm of the way we look at things. And it was you would know practically like how to run a back test and how to what are the problems faced, and kind of discussions which we are having today in spaces. And it kind of really democratized the knowledge. So if somebody says that the knowledge is not available in the public domain, he's not right, because what I spoke about today, even the implied probability distribution, and I'm going to share a really nice take on this by a person I follow in on Twitter called Robert, I think Robert Martin.
Robert
Yeah,
Martin. Yeah.
yeah. On it's called Reasonable Deviations, his blog, and he beautifully explains this concept of butterflies. The point I'm trying to make here is, with this democratization of data and knowledge, I mean, you're really able to kind of take advantage, leverage of this. And plus, if you do some additional courses like FRM, which I think is a really good course, you're going to come up to a level from where you can work on. And I'll leave it there, and maybe Ankit can answer more on that. But that's my take on this.
No, and it makes sense. And Adi, if it helps, I don't come from an IIT background, right? So I made my way, whatever my career trajectory was. I didn't start at IIT. Yes, I went to school in US, and the path from there. So yes, being from IIT definitely helps, but it should not be a deterrent for you. And like Roy has already pointed out, FRM, sorry. And CQF is a new program. I know they've been running it. I think it's a little expensive, but I'm not sure about the application of that in the Indian market space. But if your motivation is to learn things, there's a lot of resources available. And I think even Roy or any of the other speakers are very, very candid with their feedback. We try and encourage people to learn when somebody, I'm sure, who reaches me, I try my best to help, and I'm sure the others here as well. So don't get disheartened. I know. Any other? I think Alok, do you want to speak something on that?
Yeah, the FRM course is really good. I've done that to what maybe a decade and a half ago. FRM is going to give you all the insights into how professional risk managers at large trading desks and banks basically manage risk, right? Options is all about risk management. It's not so much, most people pay too much importance to when to buy, when to sell, and what to do, and what your strategies are. The key aspect of options trading really is more around risk management, understanding the risks, understanding the nonlinear payoffs that you have, understanding the convexity in your trade, understanding negative convexity when you're short options. If you basically have a good handle on all of this stuff, then the entry exits and all that will take care of itself, right? I mean, setting up your skew trades and your surface trades and all of that is secondary, the way I look at it, right? So an FRM course is really the number one. I think Roy rightly mentioned it is actually a fantastic course. It's not very expensive. There's a when you register for the course, they give you a book, and that book is enough, right? And you might find an online copy somewhere as well. Just go through it. If you don't want to get an official certification, at least go through that book, and that will probably give you all the information you need. And if you're kind of just starting out in options, and for Greeks and stuff, I've repeatedly said this on social media. I'll just say again, Sheldon Natenberg's book is literally the Bible of options. He does a really good job of breaking down options trading for lay people, and not so much, it doesn't have all the complexities and the math and all that kind of stuff, right? It's actually very easily explained. Another thing for the Indian markets is the Zerodha Varsity course. If you go into Zerodha's Varsity, they have a really nice way of explaining options and how they work. So if you're starting out on options, Zerodha Varsity, Natenberg's book is enough. If you want to do a little more, detailed stuff, then the FRM course is really good.
And as for the books, there was Roy had created a list of option trading books, and I kind of created a list of Amazon links. So if you go on my timeline, you'll be able to see some of those recommendations that Roy made, and I kind of expanded on that. Also helps. I know I brought Fallibilist on the stage. I'm not sure if he wants to add to what the topic was. I think the career discussion was going on. And Fallibilist, if you have questions,
No,
I would
actually,
request you to wait because
same thing, same thing. About the resources thing, Alok covered them already. I just add in general, when amateurs get into this thing, they usually start off with a PNL perspective. And that's okay. Like, that's very exciting because you're just getting in. So you just want to make money right away. But if you're going to stick around for the long term, you want to understand things. So the first thing you want to do is survey whatever material is out there. Okay, so don't be, oh, I follow this guy on Twitter. Like, what does he do? I'll just do whatever he does. That's fine. And most of the times you'll end up buying courses that they offer. But I think a lot of people don't survey the material that's already out there. Like Roy says, this quantum stuff, it's like a gold mine. If you're really like learning on your own, I haven't seen a resource like that. So yeah, so survey more aptly. Don't buy stuff just right away. Don't believe in what people say. Survey things, and so that you can ask questions to them too, right? Like if someone says, "I sell straddles," and this is like a straddle strategy, you want to be able to ask, okay, like, what's going on here? What are you actually trying to do here? Like if you ask us, all of the people on the space will tell you that's like mostly short wall. If you're selling a straddle, it's short wall. You're cutting off a leg, okay, then it becomes trend follower. They'll tell you these things. But do you know the person you're buying from, or this person you're following who has like some kind of MTM screenshots, knows these things? You want to have that sense of how much does this person know that I can learn from? Because if you spend your time otherwise on this person and you think you're trying to do what they're trying to do, you're both away, wasting your time. He's selling you stuff and he'll just go away later, and you're not learning anything. It'll be 3 to 6 months. Bull market has already passed this, and you'll be left flat-footed. And these are the kinds of things. You don't waste your time. And the results are very good. And yeah, listen to Alok. And I think mastery is Sheldon Natenberg for anyone who's entering the space. After that, I don't know, bits and pieces. That's it, yeah.
Thanks for that perspective, man. I'm gonna call out the names for the next people in line so that they also know, and then bring more people on stage. So the ones on the stage are in the order of their occurrence will be Indraneel, followed by Sampath, followed by I thought there was another member, but then Ayush. So Indraneel, Sampath, and Ayush in that order, and then we'll assess with Roy the time and what we want to do before we bring more requests on. So Indraneel, do you want to go ahead, ask your question?
Yeah, sure. Can you hear me?
Yes, we can.
Yeah, so my question was related to the implied probability distributions Roy was talking about. So what are the pros and cons of the implied probability distribution constructed by closed butterflies approach compared to the forecasting volatility minus implied spread approach? And if all of you could talk about like volatility forecasting a bit, then that would be helpful. Hello?
Yeah, thanks. I'm gonna
Yeah.
Should I
Roy,
start?
take that.
I
Roy?
don't know. Well, I think I'll have the most minimal
Please.
amount of
Oh, sure.
things to say on this topic
Yeah, please, please.
because volatility
Yeah.
forecasting has basically not worked for me ever. Like I've spent too much time making models on it, and there's some utility in terms of getting intuition. Like for example, if you take, for example, the most popular ones like close vol or Yang Zhang volatility, like you can get a sense of, oh, so this is what is being captured here. And like volatility means a lot of things, a lot of people, right? Intuitively, you'll see like, oh yeah, it's price is flitting about. Is that volatility? Like, okay, but how do you capture it? What is a metric that I can look at and say, oh yeah, this captures that kind of move? And Yang Zhang will do that somewhat. But then most of you guys are doing this intraday stuff, and there is not a single metric that will capture that. So yeah, it hasn't been useful for me. So that's my comment.
Thanks. Roy, your thoughts on this?
Yeah, I mean, I agree with him with Fallibilist. I mean, look, there had been a conventional way of looking at markets initially, where you would have your own way or your own forecasts, and then you'll superpose that on the market. I mean, a typical example is you try to fit in a distribution which to the market, right? That approach really has not worked much in the past, and people have understood that the common language which people speak is much more important, and to align themselves to that common approach is a much better way to look at things. So what I mean is, if you have something like an implied probability distribution which the market is telling you, then you can fit yourself. Maybe you have a completely different view, that's absolutely fine. But if you kind of approach it in the same kind of framework, then it's much easier to treat that, because ultimately you're going to get a feedback of that implied, right? So let's say you put on a kurtosis trade based on the implieds today, and 15 days later you have another implied, and then you can assess your PNL based on the how the implied has moved, right? That's a much better approach than taking an approach like, let's say, a forecasting approach like a Garch model, which is like kind of heavily criticized, right? Where you're kind of using your own methods, ways to approach the market, and then you go to the market and you get a shocker, right? So it completely changes. For example, like in a Garch model, you typically take the feedback of the last n-1 days, and then you plug in the return of today, use some kind of an average, and forecast volatility. But it's not a one size fit all, right? I mean, that before an event, that's never going to work, because the volatility before and after the events are completely different, and you kind of have what do you call, a discontinuity over there, right? So my take would be, and I'm a little biased towards implieds, that if you have a certain way in which market is talking to you, you kind of pick up that language and speak in that and express your views, rather than creating a completely different kind of a framework which does not fit into the market. That's my take.
Lovely. Thank you for that. Ayush, uh, last question from you before we take a pause.
Hey guys, can you hear me?
Yes, please go ahead.
Yes. So basically, I'm in India right now. Currently, like I just had one thing that I was very interested in. Like, I think you mentioned or Alok mentioned about like U.S. markets being more efficient, and like obviously they have more financial sophistication, and like India is still to reach that point. But from a trader's perspective, do you think there's a higher chance that you might be able to find your edge in the Indian markets than you can in the US markets?
I think Polyvalence should answer this. He had a big take on this. I think he should answer this.
You're talking to me.
And you had the take on this. I mean, go ahead, man.
Oh, I don't know where to begin. Here's the thing: Indian markets is super inefficient, and that's great for amateur traders, starters. Like you can make a lot of mistakes. Like you don't. That's the thing I don't understand on FinTwit. Like these guys are making a lot of mistakes, and they're getting away with it. They're not having that much of tail risk as they expect. Our markets are also not down as much. Like right now, we have all these SIP flows coming in, and those are basically dumb money flows, right? They're going into large caps. They don't go anywhere else. So if you look at all these conditions, a lot of inefficiency in the market, and that's just great for you. And in regards to Western markets, the thing you can actually do is you can go read about the history, like what has happened, the history of crashes, and how the markets have gotten efficient. Because we're going to become efficient,
Exactly.
kind of along similar routes, right? And who's going to do this? Who's going to make markets efficient? You and me, right? Because who are the big guys
Exactly.
here? There are no hedge funds here, not yet anyway. They're gonna come once the markets grow. But in the meantime, you're doing this business, so make it efficient. Yeah.
I mean, yeah, exactly. That was one of my views as well. Like, see, I've been like, I'm a student currently. I'm still learning, like, similar to another person who is here who is thinking about taking on a course. Me as well. Like, I know I do not have the discipline to like work all the time and like actually get things done myself. So I'm going to be enrolling on a course. But I was actually in between the thoughts about if I should go on to like pursue studies and like obviously like Ankit his degree from UC Berkeley. When you have parents like pressuring you to go, like, yeah, you need to go to the States, that's where it is at. Like, it's nice to see that, obviously, that listening from experienced speakers like you, that there are things you can actually do within India as well. And then you telling me that, yeah, we are the ones gonna make it efficient in the future is giving me more conviction.
Yeah, I mean, look, let me add a point here, right? I mean, and I'll try not to repeat what was already spoken. So you know that the best books, the best analysis are all done in the US markets currently, because obviously the number of players are more, and the best minds are in the US markets, right? So why don't you try this? I mean, let's say you buy a book or you read a paper, right, on where the analysis has been done on a US market. You try to replicate that on Indian market,
Okay.
right? So I mean, that's a very simplistic way of learning things. I mean, then you'll see that what are the challenges. So a few moments back Prashant was talking about, okay, does this work on Nifty and Bank Nifty? The now moment you try to do that exercise of implied probability distributions, you try to you come to know that whether it works and whether you're able to get what you're trying to do here, right? And that's what learning is, and that's what we want to bring out through this space which we are doing. That as a young mind, more than trying to make money, the focus should be on the process, right? I mean, whether you're going to can learn something from these spaces, look at some research work and do some analysis on Indian markets and see whether it works or not, or am I talking all crap, right? I mean, so
Exactly.
that's what my limited point is. And you know uh, try to do things by hand and not reading up someone else, or just listening to someone and in spaces and
Obviously,
thinking
like, I
that is
mean,
the
not
right thing.
replicating someone else's thoughts as your own.
Yeah, thanks.
Thanks, Ayush. Thanks for your question.
Thank you so much. I would just like to ask like one request from like if any of you could do this. Like I would just if you could make a thread or something on Twitter as well, or like for newbies who could like follow up on resources which you've already gone through. I know like I'll be able to see on your timeline like already, but like getting all of your perspectives would be very helpful.
Yeah, so the things we discussed today, we'll add some resources on this. Maybe Ankit will add that. I'll share something with you, Ankit, and if you have more you can add that.
Sure. Thanks.
Okay, thanks a lot. Thanks a lot, guys.
So I know Roy and Prashant, Alok, we've been speaking for a good 2 hours now. I don't know how much bandwidth you have. I have one, two, three, six, seven more requests. Um,
Prashant and me have actually been talking for the past 8 hours and then another 2 hours. So we've been talking nonstop for 10 hours any which way. So what's another couple of hours, man?
Okay, then let's. What we should. What I'll
You
do is,
guys
I
are beers
think
in hand, or
Roy.
you just doing this like freehand?
Sorry, your voice broke in Falbus.
So do you guys have beers in hand, or you just doing this freehand for 8 hours?
No, so we do like mentorship sessions. We are mentoring people who are trying to learn options trading the right way, and we do a one-on-one mentoring with them. So we had 4 back-to-back sessions today. Weekends are the only times me and Prashant both have to do this, right? So that's why.
Cool. Awesome. All right. So what I'm gonna do is I'm going to accept the requests that we have, and then once these 6, 7 requests are over, I'm gonna. I mean, I think we're gonna close it out. So it might not be in the best of the orders, but I'm just gonna try and approve few of
Ankit, did we
them.
get through everything that we had on the agenda, or there's still some things left?
No, I think there were some things left, but I think maybe we
Why
can.
not do it then, right?
Roy,
No, I
do you want
I
to?
would rather hear Roy talk about it.
Sure. Roy, you want to talk about the tail and the skew,
Yeah, I
the
mean,
last part?
yeah, I mean, we already talked about implied probability distributions. The thing that is probably left is trading skews and the tail, right? And yeah, we can talk about it. Ankit, I do have a stop in the next 20 minutes or so, so I mean, I can continue for
Sure.
another 20
So
minutes.
then, yeah,
Yeah.
why don't you talk about it, and then whatever questions we have, we can, some people who can stay back can take in. But I think it's useful if you speak, and then the questions can always come in later. So please go ahead.
Okay, sure. So, yeah, so coming back to this implied probability distribution. So now that we have a probability distribution, the important question for a trader is what am I going to do with that distribution, right? I mean, okay, fine, you have done all this mathematical jugglery and you've come up with a nice looking distribution. That's all academic, right? I mean, how do I use it, right? So for that, is our next topic, and how do we trade this out, right? So I've already spoken about it a bit, but like maybe I'll try to expand on it a bit more. So in any distribution which you have, and if you have some exposure to statistics, you'll know that there are moments of a distribution. So by moments, what I mean is there are some characteristics of the distribution which are kind of given by this moment. So when I talk about sorry, when I talk about, let's say, a mean, or the movement of the underlying, that's the first moment. Okay, the second moment is basically volatility, or the dispersion from the mean, or the move away from the mean, or in either direction, to up or down. The third moment is skews, and the fourth moment is kurtosis. Okay, and there are higher moments, there can be higher moments than this, but these are broadly the four moments which are broadly talked about, and these are kind of the ways in which we fit in our analysis. Okay, so let me give a little history. When Black and Scholes came up with their option pricing model, if you have read a little about it, I mean, the audience, you would know that it was a flat wall model, which means that at every strike, they kept the volatility constant, and then uh, they had, for an underlying, they had a particular volatility to price those options. Now that was an assumption of the model, and that would mean that there would be no skew, or there would be no kind of kurtosis in the model, right? So that's how simplistic the Black-Scholes optional pricing was. But what happened after 1987 crash was, these options which were out of the money were being priced more, as people became more and more fearful about another crash coming. So the out of the money options were being priced more than if you use the same inputs as the ATM options. This, in market parlance, would be known as a skew, right? So if you start with a standard normal distribution, then you have two features. One is your mean and one is your standard deviation. So as you would know that a Black-Scholes option price would use a log normal distribution, or the distribution of returns of the stock price or the underlying would be normal, right? So that's the whole assumption. Okay, let's I'll not try to go into too much of technicality, but what I'm trying to say here is people then found smarter ways to tweak the Black-Scholes model, because as we talked about before, right? I mean, market already spoke the language of Black-Scholes, so no point kind of you know changing the language. So what they did was they tweaked the Black-Scholes model, and then they came up with this modified Black-Scholes, which kind of told you, which introduced two more moments. One is skew and one is kurtosis. Okay, so and the subsequent models, whichever came up after Black-Scholes, was trying to characterize the market based on these four moments, which is your uh, the first two, and skew and kurtosis, right? Now, what an implied probability distribution it does is it gives you a value for your skew and your kurtosis, right? So what is done in analytics is basically we create something known as a volatility surface. Now this volatility surface means it's a graph of volatility between strike price and time versus volatility. So it's a three-dimensional surface, and so it's a continuous surface. So at every point, whichever is not trading or not, there would be an interpolation. So there would be a surface which is kind of defining the current position of the market. Okay, now like you have in implied volatility versus realized volatility trade, which is known as which is basically you're trying to do by selling straddles and kind of rebalancing it. You're trying to capture the implied volatility minus the realized volatility. If you are able to capture a positive difference between the two, you make money. You lose money if you don't, if it's the other way around. Similarly, there is something called skew trading, where we are trying to gain extract a PNL from the implied skew versus the realized skew. Now, what do I mean by a realized Q? A realized Q means that it's mathematically it's the third moment of the distribution, which is kind of an integration formula. I'll not go into that. But what we are essentially trying to do is it is this Q number, this realized Q number is basically coming from the correlation between stock and volatility, or spot and volatility. Okay, so it's basically implied skew is basically the covariance, which is correlation multiplied by the volatility of volatility. But let me tell you something very simply what it means. You have a time series of volatility and you have a time series of spot prices. From the spot prices, you can find out what is the volatility of that stock movement, and from that time series of volatility you can find out what is the volatility of volatility. Basically, how volatile is that volatility. Okay, so it's kind of derived from that, and then you're trying to find out how they correlate, right? So historically you can find out how it correlates using a correlation formula. uh, like realized volatility, realized Q is exactly the same. From the time you put on the trade to the time at expiry, you find out what is the realized Q based on this covariance formula. Correlation. So what is implied skew? Implied skew is, to speak in a very kind of simple language, it is basically giving you the difference between the the volatility of an out of the money put option and let's say an out of the money call option. The difference between the two is basically the skew. You it is not a very kind of strict definition, but that is what we are trying to do here. We are trying to sell the higher vol when you're shorting a skew, and you're trying to buy a vol which is smaller, and then you see at expiry like how that realized over the path, right? So that is broadly what I mean by skew trading. And based on how slope, what is the slope of the two, you kind of take a position, and that slope measure is giving you that implied skew position. So how do you do it? You buy a 25 delta call option and you sell a 25 delta put option. You can do the other way also, to get a long, to flip a long to a short position. Now, 25 delta call option, and by selling a 25 delta put option, your delta is doubled, right? So that a 25 delta call option will have a delta of 0.25, and if you sell a 25 delta put option, your delta is minus 0.25. So 0.25 minus of minus 0.25, your delta becomes 0.5. Now, this zero point 0.5 delta is not good for me to express the view, because if the market moves, I'm kind of having a sensitivity to the market. So what I do is I hedge out this delta. So whatever is my position, I sell half the position in through futures or whatever, and then I make it delta neutral. Then I have a kind of a pure skew position, which I am trying to measure up against the market and see that if the skew flattens, I'm kind of making money or not. So this is broadly what skew trading is. I don't know if that made any sense, but that's what I would think
It
of.
it did. Can I ask a couple of questions?
Sure.
Uh, so you talked about selling puts, buying calls, right?
Mm,
Generally, a structure like this will one have negative gamma, and two
mm.
it'll have positive vana, right?
Yes.
So this is essentially a risk reversal trade where it's not so much the skew normalizing, but it's vana which is going to have a huge impact on your PNL and your adjustments, right?
Mm,
Uh,
mm,
I like to do it the other way around, right? Means when I get an opportunity, I'd rather go long skew where I'll go long out of the money puts and then
mm.
short out of the money calls, right? Now,
Sure,
this
sure.
structure will one give you positive gamma, and at the same time, it will also give you negative vana, right? And so, when the market does fall, yeah, your risk on this trade is essentially a large fall in the market, right? When the market falls large, if you have short puts, you got to scramble to adjust your positions, right? And
Mm,
all your
mm,
adjustments are going to be negative gamma, right? So,
mm.
typically the way we kind of trade risk reversals are always looking for opportunities to go long put skew and short call skew,
Sure,
and that
sure.
that to me more makes more intuitive sense, right?
Sure, absolutely. I mean, I was trying to define it. How, I mean, how an implied skew would, and you're absolutely right. I mean, because of this, you're trying to take advantage of this correlation. When the market falls, the volatility should go up, and you
Correct,
buy long puts. I mean, that's probably what you're talking about. Is a long skew. I probably
correct,
talked about a short skew, right?
correct,
Yeah,
right.
yeah.
Yeah.
So
The
I
the
agree
other
with
thing
you.
is when we normally do skew trades, we'll just normally do it to the put side, right? So we'll do like an ATM put or a slightly OTM put along with way out of the money puts, right?
Hmm.
We normally don't do long put short call or risk reversal kind of structures. We rather just do put to put, maybe
Sure,
do like an ATM and the out of the money puts. So we'll only
sure.
take the left part of the smile and not the right end.
Sure, absolutely. I mean, that probably works well for equities. Maybe for commodities, it's the other way around. I mean, I'm not sure. Maybe,
Sure, sure,
maybe,
sure.
maybe.
Yeah. We're talking
Yeah,
equities here, man. There are
yeah,
no
yeah.
commodity
Absolutely.
options in India. What are you talking about?
No, absolutely. Yeah. I mean, yeah, you're absolutely right. I mean, I I was kind of making a generic kind of,
Sure,
yeah,
man, sure.
but yes, you're absolutely right. I mean, that's one way to play through put spreads, or you can play it through back spreads, or
Yeah.
I mean, ratios. I mean,
Yeah,
that's
I
all.
like back spreads because like I said, if the skew has to materialize,
Hmm,
then there are few instances where you'll probably benefit if the ATM wall dumps right relative to your back. more often than not, your skew is going to expand with a move lower, right? So
Yes.
when a market moves lower, you want to have that one positive, vega on your book, and two, obviously when the skew materializes, you have a lot more quantity of long puts, right? So back spreads are really
Yes.
the right way. I really love trading, a long skew position using back spreads.
Yes, absolutely, and maybe it's a good way to hedge tail exposure as well. I mean, it's kind of
Totally.
I mean, again,
It's something, yeah, it's something that we're always looking for an opportunity, because we essentially run a fairly large sized short wall book, right? So any opportunity we have to basically hedge that tail risk in the form of a long skew trade, we'd happily put that on. And in a
yeah,
blink of an eye. We're happy to even lose, money on that trade because it's providing a fantastic utility to our overall book.
sure, sure. That's great. That's great.
Alok, if
Yeah,
you,
yeah.
I know, Alok, you have a background in trading commodities. I mean, yes, Indian markets may not,
Don't get me
but just
started, man.
to, no, no,
Uh, I,
I just, my question is just to probably provide a contrast, right? Maybe not going in a lot of details from an international commodities perspective. You guys spoke about how equity skews behave differently than commodities. So just for the contrast perspective, uh, what are the differentiators between, let's say an equities and a commodities setups or, skews?
Yeah, I mean the basic essential difference is that commodity shocks are generally going to be on the upside, right? Equity shocks are generally on the downside. So when Roy was basically saying that, yeah, commodity space, you'd probably be trading the right side of your smile. That's probably more accurate, right? Because if I had to trade a long skew position, I'd rather just do a call back spread rather than like a put side trade, right? Because the shocks, any shock, typical shock on a commodity side is going to be on the upside, right? And so you want to basically play for those tail events on the upside rather than on the downside. On equities, your risk is on the downside. So other than that, everything remains the same, right? Your analysis and your views are essentially all the same. It's just that you choose to play it from the call side for commodities.
Makes sense. Makes perfect sense. Uh, Roy, would you like to
Yeah.
add more?
No, I mean, great discussion. I mean, we can go on and on this, especially on currencies. If we start currencies, probably will not end today.
Yeah, currency, same
Right.
thing as commodities, right?
Yeah.
Essentially, you play from the long side, on the call
Yeah, I
side.
mean, for EM currencies, maybe on the right side, and then for something like G10, probably it's more balanced. I mean, there can be takes on this, right? So, yeah.
So we have three request speakers. I'm just gonna add them all, and then I think once we have them ask their questions, we'll probably end this space.
Yeah, sounds good,
So
man.
the first one is no. Hey, where did that go? I accepted somebody's request, and that guy probably dropped off. Anyways, Devashish, do you want to speak next? Devashish, do you have a question? Not sure if he does. Prashant, do you want to speak? All right. It seems there are no questions. We're gonna, I don't know if any of the panelists have any closing thoughts. Dhruv is asked. Okay, they have two more people requesting. So let me just try to add them so that we can have some bit of closing discussions. Dhruv and Gaurav have been added. Dhruv, do you want to go first?
Yeah, hi Ankit, hi Roy, hi Alok, hi Prashant. So Alok, I just had a question with you. First of all, great discussion. Just the overall thought process behind what you all are doing is great to know. So I had a question for Alok. Like you said, you manage a big short wall book, and as a hedge, you look at buying and selling price. Yeah, can you hear?
Sorry. Yeah, go ahead. I think somebody else. Hey, Ankit, can you wait? Ankit Kachiwala, can you speak? Wait for your turn, please.
Okay.
Sorry, Dhruv. Please go ahead.
So, Alok, I just wanted to ask you more about the hedging part that you do. So, you carry a short wall book majorly, I think you said. So, when you buy the put and sell the call as a skew trade, just for positive skew. How do you size it compared to your overall exposure? And do you do it on the weeklies, Nifty, Bank Nifty, or do you do it on the monthlies? Could you just explain that a bit?
Yeah, absolutely. Both, right? I mean, it just depends on what our view is. Typically, we are looking for opportunities, skew trades on both weekly and monthly options, right? And so every now and then there's an opportunity on the monthlies. So Roy talked about the slope of the skew curve. So we do extensive analysis on on that slope. While the markets are on, we are continuously scanning for an opportunity to go long skew. We've done a lot of historical analysis around what that skew looks like. So we have a nice distribution of that skew, the slope. Once we have a view, right, that there is a minimum threshold that it meets. If it meets that on a weekly, it meets that on a monthly, we'll happily take that skew on. In terms of sizing, the skew trades are not automated yet, right? For us, it's one of the few strategies where there are a lot of different ways. Roy talked about a few ways to play it. We still haven't figured out what the most optimal way to play a long skew trade is, right? And so, when the signals are generated, we are basically putting on discretionary structures around a skew based on our view in terms of whether risk reversal is the right one, whether put back spreads, whether it's just a regular put spread with a delta hedge on. So there are all these different considerations that we take at a point in time, and then we'll size that. Typically, the skew trade is put on as an independent trade outside of what our current systems are having. So we don't always put on a skew trade as a hedge. The skew trade runs as its own system, but it's so far it is a discretionary trade that we internally, so the analysis is automated. The decision on what to trade and how to trade and how much to trade is still a discretionary process. So my point was that we'll generally always have some short options on our book. Not that not having a skew trade hurts us in any form, even if we get a large move, because our position sizing is always in check. But it's always nice to have some tail risk on, especially when market's giving you an opportunity to do it. Does that answer your question, Dhruv?
Just one more thing to add. So generally, especially if you're doing it discretionary, what happens is some of the strikes aren't really available to you, even just when you want it. So based on strike availability, also you're also going to do something a little suboptimal, which is fine because you got to do something rather than nothing. So, but that's also one of the conditions that goes into backspreads, especially because strike selection is not always under your control. Yeah.
Yeah, I mean, so we do our the slope analysis is done based on moneyness, right? And so we're continuously looking for multiple different moneyness slopes. If it triggers on a specific strike difference is when we'll put the trade on, right? So like I said, the analysis piece is all completely automated. So we are generating daily signals on skews. It's just that when the trade triggers, we are taking discretionary sizes and discretionary trades on that.
Great. Thanks a lot. Thanks.
Thanks,
Great to know. Yeah, just to add, Fallible is the key thing is not which strike or which structure. So I might when something like this pops up, I might throw out short call, long put. Alok might throw out short in the money put, long OTM puts. The key is just putting it on, I guess. So it's not so much as the which structure and which strike that's as critical as just having it on, because the skew is way below what we think the threshold and the historical data.
Right. So that is what I'm trying to say. It might look suboptimal, but it's still better than not trading it. It's still
exactly.
Yeah, exactly.
That's what. Yeah.
Awesome.
That's always with long options, right? Don't think, just get into the long option trade and then figure out what is to be done next.
That's precisely why I don't get into it personally.
Okay. Gaurav, do you want to speak next?
Yeah. So I have two questions. Like I generally do directional credit spread. So in that, I keep the difference between two strike very tight, say 100 point. So the realization is bit slow. That's why Friday and Monday generally doesn't have help. So I keep it tight. So that is one thing on tightness of the credit spread. If you can point something, and the other thing is the risk management side. Let's say my spread is 100 point. I'm getting 20. So my risk is 80. So is it better to have the position sizing considering the whole 80 point as the risk, or you the spread is 20, you keep a stop loss, let's say, on 40, and you position size accordingly? Because in weekly sometime that because of gamma and this, because the strike would be so near, that it is always better to consider the whole width of the spread as the total risk.
When you say
So this,
spread, is are you just talking like just credit spread, like one you sell one and buy the other? Is that it?
yeah. Let's say I know my view is bullish. So I'll sell, let's say, now 15,500 put and buy 15,400. So that's 100 point with spread. So that's what I'm referring.
Yeah, I don't look at spreads in terms of the credit received and the risk in the spread. I'm looking at the spread as what is the net deltas that I'm doing on that spread. And the whole reason I want to put on a spread is to one, not take a view on any of the other Greeks and just have a view on delta, where I don't want to use a future, and I don't want to trade a future. So I don't want that tail risk on my book. So I'll have a spread on, and I will typically have it where if you look at the structural payoff of a spread, there are essentially these. You could break it up into three broad zones, where on the downside, if you did a bullish put spread, on the downside there's this convex area. In the middle, there's something similar to a linear zone, and then on the upside there's this concave payoff. So I like to keep myself in that central linear zone, and so that I'm essentially minimizing all my other Greeks and just trading delta. And the only reason to do that is because I don't want to trade future. So I typically don't do OTM credit spreads. If I'm trading a spread, I'm trading it for direction. So I want the delta in the trade, and then I'm sizing it based on how many deltas I want in my trade, not in terms of how many rupees I've collected credit or debit and so on.
Okay, so generally I think you are selling the at the money options, right?
Yeah, if
And
I do at the money,
Yeah,
I'm
I
still
mean,
not getting to
you can
that
do
linear
pretty
zone.
much any strike, right? We've talked about the option chain being a continuum, right? I mean, so you can pick an in the money option, out of the money option. Ultimately, like Prashant said, what you're trying to do is target your deltas, right? Supposing if you're doing it on Nifty and say you want to have a certain amount of Nifty position on your book, right? You have a view and you want to have 10 delta exposure, right? You want to have 10 shares of Nifty short. You can do your strike selection based on whatever the credit spread delta is, right? Now, once you put that spread on, you know what your risk is, right? You have, like Prashant said, there are three pieces to that, that credit spread or the debit spread, and essentially, you know that your risk is limited. It doesn't really matter, because if you're going to do one lot of a 10 delta spread, your risk is limited to 10 into whatever the market moves, right? And that's about your risk. Your risk is well defined even before you enter the trade. So these are good structures to play your bullish view. Here in these kind of structures, we don't look at what the risk to reward is.
okay, got you.
Yeah,
Thanks.
great points. Great points. I'll just add something. I mean, a put spread or a call spread is also, sensitive to volatility. So, if you're in the money and the vol drops, then the MTM is going to drop, right? So I mean, the point we are trying to make is, it doesn't matter what structure you're trying to put on. I mean, look at it from the angle of what risks you're taking on.
Yeah, so like the other things I'll also add is, for example, if the market goes down, there are many times you can see on the weeklies the call skew gets heightened. So in that time, for example, you can say you might be bearish in the market, but it would be actually not advisable to take an OTM call spread, credit call spread because you'll actually not be earning much. Instead, what you want to do is short the call skew, even be negative delta if you want that way. And if the market moves upward, also you'll actually gain from the skew. Okay. So you want to know what are the Greeks you want to target when you take a trade, and then come up with the structure. Don't go backward. That oh, I'm bearish, so I should trade a spread, and then try to pigeonhole the strikes. Don't do that.
Okay, thanks, guys. We can move on. Last two speakers, probably. Sandeep, you want to go next?
Hi, my question is actually to all of y'all. My question is that how do you factor in the Nifty, for example, index cash future differentials? Because Nifty tends to go from 40 points in discount to 50 points in premium, and that tends to affect the ITM and OTM puts and call IVs on the screen. So how do you like? There are days when Nifty is at 40 points discount, goes to 0 points, even maybe to premium. That so even if your trades are on point when it comes to skew trades, you tend to not make money just because of the Nifty the cash future differentials going wonky. How do you all model that into your systems? Is what my question is. Thank you.
So if you're trading the monthly options, all those options are going to price off the monthly future. So because simply all your put call parity algos, your box algos, or any of those algos are sitting and essentially nullifying your put call parity discrepancies, and with the future, not with a basket of the Nifty stocks underlying. So that is driving your option pricing. So it really doesn't matter whether the future is going contango backwardation with spot, as much as the fact that options and futures are at parity with the put call parity.
So just from the market structure side, what people need to understand is towards the spot or the options are modeled on the future. So let's say future spot, okay, this correlation is mixed up, this is discount premium. But it doesn't matter because we're again talking about the option future parity, which will always hold. So you don't need to worry about it.
All right. Thank you. Understood.
Yeah,
Thanks,
Sandeep, that would be your separate market structure trade, right? That would be your spot
Right.
futures parity trade. That would be separate from the options trade.
Yeah. Yeah.
Thanks, Sandeep. Dave, do you want to go next?
Yes, thank you for allowing me to speak. I hope everyone is having a great weekend. My question to you guys is about gamma expose. Um, how does the institution use the gamma expose their advantages? Now, I'll give an example. Let's say if you see Apple and you see a gamma expose on the downside of 130 and the upside is 150, and you see the numbers in gamma is negative. How does the institution, or if you guys can help me out or explain it more, how do they use it to their advantages to hedge the fund or make on the upside?
Roy or Prashant, you have an answer for that?
I mean, look, if I got your question, like every institution will have its own book, and it will be rather contextual. I mean, I can't give a one size fit all answer for this. Like I mean, if you're short gamma and the gamma is exploding, you kind of try to manage it out by cutting the exposure, or if you are facing something like pin risk, where you're too close to expiry, and your spot is kind of hovering around at the strike where you're short the pins. So I mean, I really don't have a one size answer for this, but yes, I mean, you would be looking for, if you're probably on a sell side, you'll probably look at it on a portfolio level, what kind of risks you have, and what kind of portfolio gamma you have, and how do you manage that exposure. I mean, Maybe I've not given a convincing answer for this, but I really don't know how to answer this in a one size
So
fit all manner.
let me try. Dave, are you asking about the GEX, which is the gamma exposure on every underlying? So when you talked about Apple at 130 and 150, is that the strike at which gamma flips from negative to positive? Is that? I mean, I'm trying to still figure out what your question is.
Yes, that is what I'm
Yeah.
that is
So
correct.
so let me try and explain what gamma exposure is, right? So basically, what you're doing with GEX is you're trying to look at the open interest of every option out there and looking at the gamma of that option, right? And when you multiply the gamma with the OI, you basically get the gamma OI at each strike. Okay. Now there is a point at which a system will have more short puts and long calls, and at some point that gamma will flip from negative to positive. Right now, that gamma flip level is critical because when the market breaches that, when it flips from positive gamma to negative gamma, is where institutions have to basically take action in order to negate their short gamma, right? And the way you negate your short gamma is you're probably short puts at that particular strike. The entire market has short puts at that strike, and so when the market falls under that level, all those dealers short positions have to be unwound, or risk reduction mode goes in, whereby they are selling more futures, right? So once the market flips from positive gamma to negative gamma environment is where you start seeing fairly large volatile moves on the underlying, right? When the market flips back into positive gamma zone, right? So when you flip from negative gamma to positive gamma, essentially what is happening is dealers now are sitting on some form of positive gamma, which whereby market goes up, they are gaining deltas, they're selling, the market becomes a lot more calmer, right? And so the gamma flip level is some kind of a demarcation at which the market volatility will start very rapidly increasing. And so, it's nice to watch it, but a lot of times you'll also see the gamma flip level change very rapidly as you get closer to that flip level, right? So at some point, as the market's getting to that flip level, a lot of the OI on that particular strike is being unwound, and the market's pushing the open interest further lower. So that dynamic adjustment is already happening almost in real time, right? So we track this on the Nifty and the Bank Nifty, and we do see that when the market approaches that very critical level on which the OI is about to flip, the gamma is about to flip, we see some very rapid changes. And if there is a gap down under that level, right, once you go, say you close in positive gamma zone and the market gaps down into negative gamma the next morning, that's when chaos takes place, right? That's when you see very large size movements on both sides as people are adjusting their short gamma exposure. David, does that answer your question a little bit?
Yes, it does. So my next question is: so more if the gamma goes on the negative side, the volatility once it goes into positive is going to be very, you'll say very violent, very high. It will jump up really high. Am I
It will,
making?
yeah.
It will.
Yes.
Okay, and I also noticed on the gamma, like the strike price I gave you, I also compare it with the open interest price, which matches compared to the gamma price, like the strike
It
price.
should, right? It should, because gamma OI or the GEX is essentially just the OI multiplied by the gamma on the strike. So generally the gamma is not as large a component. It is the OI which is kind of driving the show there. So every now and then you will see the gamma take precedence or importance, but for the large part, the larger the OI on a strike, the higher is the gamma exposure on that strike.
Okay, thank you. So is it safe to say those numbers eventually acts as a magnet to go back? It's gonna hit that number.
It does, right? Whether it's a magnet or not, I don't know, right? Because a lot of times we do see the market kind of operating inside positive gamma zone and never challenges negative gamma, right? So as long as that flip level is not challenged, the markets are fairly calm. If the market challenges the flip level, is when you start seeing some violence.
Thank you very much. And my question about is diagonal spread. Which spread would you think, would you suggest that's the most advantages for less risk and higher profit on the spread?
What spread did you ask about?
I
Your
think
voice broke in between.
Diagonals.
I still didn't get it. Like, I don't know if it's my internet or I can't hear you guys well.
Diagonal, Alok, diagonal spreads.
Yes, that's
Di-
correct.
diagonal spreads. Are you talking about a cross surface or just a regular credit spread?
Can
You're
you
talking
speak
about
about both?
calendars?
Can I have both?
Calendar diagonals?
Can you repeat that?
So I don't think he's talking about across surface. I think he's talking about on one single dimension.
Yes, one single dimension. That is.
Yeah. I'm not sure if Alok has some issues with connectivity. Anybody else, Prashant, Roy, or Falibus, want to add to that?
So when we typically talk about diagonals, we're referring to calendars. So it would be one strike is one expiry and the other strike is another expiry. But if you're referring to just the same expiry, credit or debit spreads, yeah, they're useful for eliminating some of the other risks if you're structuring them in zones where you're essentially your theta, vega, and your gammas are close to zero. And with diagonal spreads, they are a lot more tricky because your wall surface can change from one expiry to the other, and that can be related to events that are happening between those two expiries. It can be events that are happening before the first expiry. All those factors, and they can behave quite independent of each other as well. If you're talking about across expiries, so they're a lot more dynamic than just the same expiry. So if I'm trading direction, then I would just prefer to keep my trades on the same expiry and not go across expiries. But if there is a view that I'm taking about an event that is happening maybe between those two expiries, or say I'm looking at a weekly and a monthly expiry, and there's an event before the weekly expiry, then my view could be that the weeklies are elevated because of that event, and once the event goes away, the monthlies are not pretty much affected by that event. So you would have an elevation on the weekly expiry IVs versus the monthlies. So that could be a view that one could take with those kind of diagonal spreads.
All right.
Thanks,
Thank you very
Prashant.
much.
Thanks, Dave, for your question. Okay, we're going towards the end of it. Last speaker, Vimal. Yours will be the last set of questions before we wrap it up. So please
Yeah,
go
yeah.
ahead.
Thanks a lot, Ankit ji. It's a very, very fantastic space today. I'm fortunate to participate. Fortunately, my question has been covered. I had queries on wall explosion actually. So I think Mr. Dev already, shared a lot of knowledge. You all guys. So my query stands now fulfilled.
Okay,
Thanks.
great then. All right, thank you. I guess this brings us to the end of the space. It's been good 3 hours for the discussion. Any closing thoughts by the current speakers before we call it a day? Roy, Alok, Prashant, Feliblist. Anybody who'd like to add anything towards the end?
Yeah, maybe I'll speak in the end if anyone else
Yeah,
has thoughts.
let's give Roy the last word. I just want to say thanks to Ankit and Roy for putting this up, because it's a refreshing discussion on spaces, and I really liked a lot of the discussion that happened. So thanks a lot. Yeah.
So can I
Likewise,
request sorry, Alok, for the request for
yeah.
for the appreciating Roy. I know there's a lot of audience, so if you can just tap your smileys, just show Roy that he's being appreciated. I know he keeps asking me these questions. Did I do the right thing? Am I speaking well? So on your panel, Twitter Space panel, you have these smileys. So any smileys will highly appreciate. Thank you, Roy. And sorry, Alok, I had to cut you short. Please.
No, I just want to add that Alok, just one sec. I just want to add that it's only 3 hours. I was expecting an 8-hour marathon, but it's only 3 hours.
Likewise, I mentioned earlier that I normally don't do spaces. I'm not very good at, not being able to communicate without writing, without, kind of doing my analysis, right? So it's very difficult to speak without, and Roy kind of mentioned that as well, that sometimes it's very difficult to talk through this stuff without actually showing things. And at the same time, one spaces on the phone. I'm more of a PC guy. I'm on the computer all day long. So it's also from a timing point of view. A lot of these happen late in the evening. I'm an early sleeper, right? So, but for this one, I was looking forward to it. I'm really glad we did this. Thank you, Roy. Fantastic job, man. Thanks, Ankit.
Please, man, you kind of stole my words there.
Fabulous. Do you wanna anything from your side, man? I know you joined late on the panel. I know. Not sure. All right. Before Roy speaks, I'll probably give it a quick closing. So, Roy and I, how this space came about. Just a little context now that we've spoken through this. Roy and I have bounced off this idea of conducting something like this with the, which is slightly more advanced, and we've always been hesitant to do so given there's like the points you guys have made, without a screen, without any supporting material, it's difficult to bring out the idea, especially what Roy talks about. And I mean, I think Roy was one of my few connections when I started out, one of the early connections. And over the period of time, I've grown to understand his language a lot more, for a lack of better word. When I started, it was all gibberish to me. I don't come from an options trading background. I have a slightly different background from trading. So that's why I feel to encourage people that if you try and put in effort, this is not rocket science. You just need to be out there. And Roy is always willing to help, right? He's always trying to answer those questions if you go out and ask him. So he and I have had this discussion, and Roy has always been like, "Me, I don't want to speak. I don't want to speak. Maybe if you speak, I'll be there," and stuff like that. And somehow this time around, he was keen to do that. So I'm glad he chose to work with me, so to say, and I'm glad we took this space. So Roy, thank you very much. I know I learned a lot, and we know we'll be putting up this recording and whatnot for everybody else to revisit later. And I want to give that stage to you, Roy, to close out, to hear your thoughts at the end. But thank you very much, man.
Thank you, Ankit. It's pretty, it's
And
getting pretty emotional.
and before going, I really want to thank Prashant and Alok as well, and Fabulous. I mean, this quality of discussion would not have been as high had you guys not been here. Like I said, I still am on a very steeper learning curve on the options trading, but you guys come from on the other side of the curve, so to say. So thank you, everybody, all three of you as well, to be on the stage. So really, really appreciate it. I know Prashant is traveling in Serbia. I know he's there for, I'm assuming, a chess tournament, Prashant, for your son. I mean, you said tournament, and that's what I assumed, right?
Yes, that's correct. That's correct.
Yeah, so
That's correct.
he's his for those who you don't know, Prashant's sons represents India in chess tournaments across the globe. So he has other responsibilities, not just options trading, but he's here with us. So I highly appreciate that.
Yeah,
And
his game's going on right now, so I'm sitting outside the avenue
okay,
and enjoying you guys speak.
perfect. All right, Roy, over to you, man.
I'm sorry to keep you out of the your son's game, and I'm really sorry. But I mean, it's been great that you guys came in and like supported me through this discussion. As you said, like it was not easy to kind of discuss quantitative ideas without a screen or something, right? So, I mean, I'm really grateful that you guys helped, all of you helped me through this. Just some closing remarks. I mean, when I started working in financial markets, and if I had heard this kind of a discussion, I would be very scared, right? I would think that this is what language these guys are talking, right? So and it's understandable that a lot of times, like as being a little experienced in the industry, you tend to kind of subconsciously talk about some things which are not very which are a little jargonized, right? And my hope is, we have tried to keep away the jargons as much as possible. I would request the young guys who are kind of starting out, or you know, have who have joined these spaces, I would request you guys to just have an inquisitive mind, and like, you know, have a look at these approaches which are there. it, I mean, after 2011, after Quantopian, you know, a lot of things have come out, you know, and are sitting in public domain. A lot of good analysis are sitting in public domain, and you know, there is no one stopping you to look at these nice discussions, nice thought outs which are there, especially right now with so many people, you know, doing it. And you know, you might get a different door from your conventional ways of making money in the market, right? I mean, so all I would request the young minds who have joined spaces today to keep an open mind, and you know, look at this analytical ideas, and maybe you find some edge based on these frameworks, right? I mean, we discussed these frameworks here because we think that, you know, an edge is kind of a short-lived and a very, you know, this thing, a myopic thing, right? But if you have a framework to work with, who knows? I mean, you might find something which we have never thought about, right? So I hope at least a few guys get inspired by these different methods which are out there, and like start exploring this. And you know, I mean, I'll dedicate this spaces to all you young guys out there. Thank you.
Awesome. All right. Thank you everybody for listening in. Thank you everybody for speaking. I hope someday we'll do it again or more other topics. Please feel free to reach out to either of the speakers if you have any questions, follow up requests. I know all of them are very welcoming with their feedback, and you know, are always eager to help. But yeah, thank you everybody. I hope wherever you are, good night, good afternoon, evening, wherever you are in the world. Thank you. We're gonna end this. Bye bye.